clearly implying liquidity will continue to be made available, and they will take further steps if necessary at this point. And Powell shrugged off suggestions that the Fed might be concerned about asset bubbles growing at this stage. So why is the market down, Chris?
I think the market's down because there seems to be a renewed outbreak in some of the states, some of the southern US states, and the market's getting a bit worried about that. And at the same time, clearly, we've had the most extraordinary recovery in markets since March the 23rd. And any hint, as there was in Powell's statement, that economic recovery isn't going to be quite as quick as some people had expected, is going to cause the markets to certainly pause for breath at this time.
And on that note, around the uptick in cases we're seeing in a few states in the U.S., in particular Texas, which has seen an uptick in the last day or so in terms of their coronavirus cases, what's actually priced in terms of the market in the U.S. with regards to a second wave?
I don't think that's priced in at all. I think the market could react quite negatively if this rate of new infections climbs from here. I think the market has been pricing in only a single rate of infections from COVID-19, and any substantial escalation of second infection, therefore a necessity to shut down economies again would provide a real problem. The key to me is whether hospitalizations increase, and I read this morning that hospitalization cases in Texas and in California have reached highs, the highest period since the middle of May, so that's definitely worrying.
Chris, I just wanted to jump in and ask you about yield curve control, because the market was anticipating they might get some direction on that from the Fed. It felt as though the Fed wanted to provide a little bit of guidance for the long term, but not too much, because perhaps it could set another spike amongst some stocks where you've seen a lot of speculation take place. What do you make of that, the Fed mindful about the escalation of those asset bubbles?
Yeah, I think it's a really tricky one, and we've seen yields come back a bit from their recent highs. I think the Fed is trying, as ever, to play a balancing game here. It doesn't want the market to get carried away with it. But obviously, with yields tending towards zero, that's just going to further inflate asset bubbles in equities over a short period of time. So, as ever, Chair Jerome Powell is trying to get this balancing act right.
Can I ask you about technology? We've seen a continued level of appetite for tech stocks. I mean, there was an element there where investors were broadening out their investments, but now technology keeps climbing to record after record. And I wonder whether there is more in the trade. I was looking at some of the announcements, even locally, from Ocado yesterday, trying to build out its customer fulfillment centres. You've had news out around the consolidation, the online delivery part of the market. These companies are not just sitting idle. They're doing more with the very strong trends that are witnessed on the back of COVID-19. What do you make of the valuations, and whether investors should be more positioned around these growth stocks?
Well, the valuations are clearly sky high. There's no question about that. But I think the interesting point here is that is a valuation based off an earnings, off a profitability and matrix. So what I think the market is doing is looking at things beyond just simple profitability and saying, well, if a company like Amazon or Ocado or many other technology stocks can show a growth profile that is going to lead it to really develop its revenue base, ultimately that will lead to profitability. I was looking at this morning at the market capitalization of Tesla, which is not far short of the market capitalization of Toyota, and has gone through the market cap of Volkswagen. And you know, in terms of, if you look at the profitability of those three companies, Tesla is nowhere near where Volkswagen and Toyota have been. So the market is looking at this through different metrics. Now, clearly, we've got to worry that if we go back to 99, 2000, those of us who remember that time will remember lots of different metrics that ultimately blew up in people's faces when people didn't realize, people got too far removed from thinking about the necessity for companies to actually make profits. So I think it's worth injecting just a tiny element of caution in terms of just expressing too many different metrics for company valuations at this stage.
Chris, you've got a broad clientele over there at St. James Place, from the high net worths to the ultra high net worths. What advice are you giving them at the moment as to what they do with their existing portfolios and how they might think about participating or otherwise in this fervour we've seen in some segments of the market?
Well, the advice is very simple, and actually it doesn't change from our long-term advice, is that we tell our clients, indeed I'm doing a client call later on this morning, that they need to be really careful about either getting carried away when markets are as rampant as they've been since March the 23rd, or becoming panicked when markets do have setbacks. So it's trying to focus on the long-term financial plan, making sure that is still appropriate, and letting the underlying fund managers who have been doing a really good job for our clients, putting money to work when others were very fearful, make those decisions in a dispassionate, objective and analytical way, which for the retail investor, even for the high net worth, ultra high net worth clients, is really, really tricky to do. It's been proven through correction after correction that it's really difficult to buy back into markets when there's blood on the streets.
That's fair enough, but if you are taking a long-term view and you are seeing the cyclical part of the market take such a hit now, I mean, isn't this the opportunity to step in, given we're seeing such a blanket sell-off in terms of cyclicals versus defensive that seems to be really moving indiscriminately within those two baskets?
Well, I think that's fair, and clearly the value versus growth dynamic is the big debate. Are we starting to see a resurgence in value stocks as we've seen over the past sort of couple of weeks? Certainly, I think the label is too simplistic. That one needs to be looking at it on a case by case basis, and it goes back to my earlier comments on how one values growth stocks. I think if you can look at different companies, whether they fall in the traditional value or in the traditional growth metrics, and say, well, actually, if I look at the opportunities that company can create, then that's going to deliver me a lot of value. That's what we want our fund managers to do. And simplistically say, well, I'm going to invest in a value index or growth index, I don't think necessarily is going to give clients the type of returns that they're seeking.
Chris, thanks for joining us. We'll see you on another day. Chris Ralph, Chief Global Strategist, St. James Place Wealth Management. What's going on with that motor merger that we were expecting between PSA and FCA? The EU is reportedly set to begin a lengthy investigation into the planned tie-up between Fiat Chrysler and the PSA group. We'll tell you a bit more about where we've got to on this apparent roadblock.
Turmoil and the Eurozone heating up.
The station you're listening to is experiencing technical difficulties. With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then, whenever you want to browse your favorites, you'll find everything under the Favorites tab.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Cover coughs and sneezes with a tissue, then throw the tissue away. Avoid touching your eyes, nose, and mouth with unwashed hands. Disinfect surfaces, bottles, handles, knobs, and other places touched often. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
Ready to talk brass tacks on what's happening in Major League Baseball? Turn to the Effectively Wild podcast from Fangraphs for daily statistics, analysis, and commentary.
One team will say, yeah, we're going to keep paying minor leaguers their stipend, and another team will say, we're going to extend the stipend through this month, and then another team will say, nope, we're cutting them off. So are extending it at least through August, which would basically be the end of the minor league regular season.
Search Effectively Wild on TuneIn to listen.
Let's be honest, we all spend too much of our day on social media. But at least you can spend your endless scroll time to discover new things on TuneIn. Follow @TuneIn on Facebook, Twitter, and Instagram to always be in the know about the best new stuff streaming in the app. From breaking news stories and live sporting events.
Yeah, but it's unique times. I think there's unique circumstances, and we're trying to
standout stations and podcasts. Stay in touch with TuneIn.
Buckle up, race fans.
NASCAR is back in the driver's seat.
And you can cut straight to...
Welcome back to Squawk Box. Let's dive into the action in the auto space this morning. Auto sales in China grew for the second straight month, rising 14.5% in May, according to industry data. The figures show a rebound for the world's biggest vehicle market after sales plunged 43% in March as the coronavirus pandemic hit the sector. The China Association of Automobile Manufacturers said government support schemes had boosted sales. We are seeing a pretty substantial sell-off in the auto space this morning amid the broader sell-off we're seeing across markets. Autos, one of the most cyclical sectors, clearly coming under particular pressure. Now, specifically, let's take a look at Fiat Chrysler and PSA. The EU will reportedly launch a 4-month investigation into Fiat Chrysler and France's PSA group. According to Reuters, the move comes after the car makers declined to offer concessions in their planned $50 billion merger to address EU antitrust concerns. And shares coming under pressure more than the broader sector. PSA down 5.6% and Fiat down about 4.9%. Let's get out to Charlotte, who joins us now with more on this story. Charlotte, what does the road ahead look like for these two companies and the merger that they're planning?
Morning, Juliana. Well, we had these reports this week of the Commission having some issues, specifically on the utilities vehicle side, that we knew that this was one of the main overlaps in the potential tie-up between PSA and FCA. You know that this was a complementary merger between these two, while FCA was very focused on Northern America, while PSA focused on Europe. But this vans business there, that is a very profitable one, a high-margin one, was one of the few overlaps. They already have a joint venture and produce a lot of their vans through that joint venture together. And yes, that was one of the identified overlaps. So it doesn't come as a surprise that the Commission would have some issues with this aspect of the business. Now, according to the reports from last night, PSA and FCA didn't make any concessions on here. So the Commission usually has about a 40% tolerance level of market share here. Overall in Europe, PSA and FCA combined would have about 34% business together, but in some countries, including Italy and France, it would be above 40%. So interesting to see what that means. Now, the overall decision has to come from the Commission by June 17th. This potential investigation doesn't come necessarily against the schedule that the two companies had to complete their merger. It's expected to be in early 2021. So this might not imply a delay, but it's interesting to see what concessions, if and when, these companies want to make. But yes, this morning, a negative reaction from the market on this, with PSA down 5.5% on French market, close to the bottom of the CAC in a negative market.
Charlotte, thank you. Still to come, competition in Russian e-commerce heats up as demand surges due to the lockdowns. So how is Ozone doing in terms of capitalizing on that increase in demand? We're going to hear from the CEO, Alexander Shulgin, that coming up.
greedy whenever you want. Subscribe to the American Greed Podcast and take your greed to go.
Crime absolutely pays, and it pays a lot.
Some people will do anything for money.
We are the dreamers.
We changed the world.
Because we don't give up.
IU can help you live your dream.
IU is an online college, so your campus is wherever you want it to be.
Take classes when you want to take classes.
You receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school.
Call IU, then tell them your dream.
1-800-967-0542. 1-800-967-0542.
Let freedom in. Freedom to work, freedom to play, freedom to learn, freedom to simply be. Now more than ever, our freedom at home is what we're all thinking about. And for those times you wish you had a space to call your own. From patio covers to pergolas, from sunrooms to full room additions, and featuring the revolution in outdoor living, the Life Room, Four Seasons has got you covered, no matter your style or budget. To ensure your well-being, we offer contactless appointments. Our teams are temperature checked, wear gloves and masks, and maintain social distancing protocol. You can visit one of our deep clean showroom locations where we follow the same rules. In support of hardworking Americans, take advantage of easy payments, and for a limited time only, call now and save up to 40%. With products that are American made, American engineered, and all American inspired. With easy payment options and limited time savings, it's time to let freedom in.
At CNBC, we follow the money. This is the big money. For me, Pebble Beach is a really good barometer for the luxury economy. And right now is a huge test because of all the uncertainty in the world. We are running and gunning 14, 16 hours straight trying to interview the collectors, trying to test drive the cars. This year's grand total of $370 million offers the latest sign that the classic car market may be slowing. We cover investing in whatever form it takes.
Trading is a lot like life. Trading has drama, energy, ups and downs.
I care about cash flow, price to earnings, balance sheet. I like to be fast. More than being fast, I like to be right.
The real excitement comes when I'm able to see something that no one else has seen yet. And when I see that unusual activity, I hit it, and I hit it hard.
Fast Money is America's post-market show.
Fast Money, weekdays 5 Eastern on CNBC.
You don't do it for the money. You do it for the love of the game. And if you're good at the game, the money will follow.
Lower for longer. Bank stocks suffer a sharp sell-off, dragging European stocks deeply into the red after the Fed vows to keep rates near zero until at least 2022, calling this the biggest economic shock in living history.
We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time.
Travel and aviation stocks crowd the bottom of the Stock 600 as Lufthansa warns of deeper job cuts and the broader sector struggles with an uncertain return to work. Bad taste. Just Eat takeaway shares slip after the European food group snaps up U.S. rival Grubhub in a $7.3 billion all-stock deal, beating Uber to the top seat at the table. We are now about a half an hour into the trading session, and as you can see behind me, it is a sea of red for European stocks. Just about a dozen single names are trading in positive territory. Otherwise, we are seeing losses for every other stock in the market. Now, this, of course, comes after the Federal Reserve meeting yesterday, where Jerome Powell vowed to keep rates essentially near zero through 2022. So a fairly accommodative policy from the Federal Reserve. Now, we have had this rally recently into the more cyclical value parts of the market as investors got really bulled up on the reopening story and saw opportunity in those depressed parts of the market, taking money out of the growth, defensive, quality parts of the market that had led the recovery since the March lows. But that trade had already begun reversing, and now we're seeing an acceleration of that reversal in that catch-up trade that had been taking place. Worth noting as well, as we just heard from a St. James strategist before the break, one other factor that could be weighing on sentiment this morning is the rise surge in new cases of coronavirus in the United States, in particular in the West and in the Deep South, in parts of the economy that have begun easing lockdown measures. So some concerns perhaps escalating around a second wave and what that means for future lockdowns in the United States. So a lot of nerves floating through markets this morning, and all of that contributing to the more than 2% drop at the open. Worth noting, though, we have bounced off the lows, so a little bit of stabilization now in about a half an hour into the session. Let's get into the sectors and see what the split looks like this morning. Clearly, we've got red across the board. As you saw there, just a dozen stocks trading in positive territory. The split, we've got healthcare, household goods, utilities, food and bev trading above the market average. So the more defensive parts of the market clearly catching a stronger bid. On the downside, we've got travel and leisure down 4%, banks, autos, and insurance. Banks obviously reacting to the Federal Reserve yesterday, lower rates, what that means for margin in the future, a margin pressure. We've got oil and gas also taking a hit down about 3.2%. And we had seen a strong bid come together for banks, autos, and oil and gas, the most unloved parts of the European market, and that is unwinding to a degree this morning. And let's take a look at banks in a little bit more detail now, and the individual movers. It's a pretty significant moves to the downside, but worth noting we have seen some pretty significant moves to the upside recently. So again, an unwind coming together. SocGen down about 6%, Commerce Bank down 5%, Deutsche Bank down about 3.9%. So broad-based sell-off across the European banks. Now let's take a look at oil and basic resources. These, again, sectors that had been performing very well in the cyclical trade that we have seen, and these names are coming under a great deal of pressure as well. We've got Glencore down nearly 4%, Total down 2.7%. So across both the energy majors and basic resources, we are seeing a sell-off this morning. Let's take a look at U.S. yields. The story yesterday was we saw yields move lower across the curve. The 10-year in particular, the 10-year yield saw its biggest drop in 8 weeks. Currently, the 10-year trading around 0.69%, so moving a little bit lower again this morning. U.S. futures, let's get a check on Wall Street. Yesterday, we saw major indices end in mixed territory. The Dow fell about 1%. S&P 500 logged its first back-to-back loss since May 13th. The NASDAQ was the outperformer yesterday. It closed above 10,000 for the first time ever, a new record high. Now it looks like we're going to see losses across the board there. The Dow Jones looking at about a 500-point drop at the open. The NASDAQ holding up a little bit better. Again, like we're seeing here in Europe, expecting to see a renewed bid for technology stocks, the real growth part of the market, which had led the initial post-March recovery rally. And finally, let's take a look at Asian markets and where we closed out the overnight, or are set to close out the overnight session. We've got the Shanghai and Shenzhen indices trading lower, but fairly contained relative to the moves we're seeing in Europe. Over in Hong Kong, the Hang Seng down 1.9%, so underperforming. We've got the Nikkei 225 down 2.8%, leading losses in the Asian session. Jeff, over to you.
Thanks very much indeed, Juliana. Just Eat Takeaway is buying Grubhub. It's a $7.3 billion food delivery mega deal. The Dutch giant beat out Uber, which approached Grubhub in February. German delivery Hero was reportedly also mulling a bid. Just Eat Takeaway will complete the deal wholly in shares with no cash changing hands. The deal follows just weeks after Takeaway.com bought out UK-based Just Eat to create a European delivery juggernaut in a $7.8 billion merger. Ocado is looking to raise £1 billion in a fresh round of equity and debt offerings. The online grocer said funds would help it capitalise on growth in its market during the pandemic. The UK company added the lockdowns could be a, quote, catalyst for a permanent and significant move towards online grocery deliveries. Ocado's stock has outpaced established food retailers, growing nearly 60% this year. Russian e-commerce company Ozone has seen sales jump as lockdowns kept consumers indoors. Ozone's value of merchandise sold doubled in the first quarter, hitting over 30 billion rubles, with growth continuing at a 200% rate in April. The company raised $150 million in new capital in March, a third of it coming from U.S. investors. Alexander Shulgin is the CEO of Ozone. Good to have you back with us on the program, Alexander. Let me just ask you straight up, what's the path to profitability look like at the moment?
Well, the company is currently in an investment phase, as we see the growth rate of GMV, gross merchandise value, accelerating for the 5 years consecutively in a row. and Q1 was finished, as you said, was 115% growth rate. In April, actually, growth rate has accelerated further to 200% growth year over year. So we are in the growth stage, and currently EBITDA of the company is negative as planned. But we see that economies of scale will eventually break even the company, and we already see a positive impact of economies of scale in our P&L. So we see path to profitability very clear as the company grows.
Yeah, has that changed at all, given the increase in revenue clearly is helping from the lockdowns, but because of the nature of this pandemic, it's obviously going to cost you more to manage a safe delivery service, and also your warehouses have to have additional PPE and medical support. What does that mean in terms of maybe slowing the trajectory to profitability? Because obviously there will be some impact on additional costs for you because of the pandemic.
Given the growth rate of the Russian e-commerce industry, and Ozon particularly, the investments that we were making in 2018-19 and continue to make in 2020, we see the path for accelerating the growth rate. And we think that, as we discussed, economies of scale that we see in the business, as density of orders increases, as utilization of fulfillment centers that we build. And this year in Moscow, for example, we launched the biggest in Russia fulfillment center of 100,000 square meters, and launching 5 more new fulfillment centers in the Russian regional cities. So all these initiatives combined with our technology investments they have allowed us to be ready for the growth that was driven by the COVID-19 impact. So the new customers that joined us on will continue to support our growth rate in Q3 and Q4. So we as a company see huge potential for growth, and don't think that will have a negative impact on our P&L.
Alexander, I'm glad you mentioned economies of scale, because there is no bigger country landmass-wise than Russia on this planet, the biggest by a long, long way. Do those economies still work, given the huge challenges in logistics in such a large country? And perhaps if you could answer a second point in this question as well, is it always going to be about a Russia strategy, or could there be an international growth strategy as well?
For now, we're of course focused on the Russian market. Maybe a few numbers about the Russian market. Only %, the share of online retail in total Russian retail market is 6%. The growth is increasing over time, but on top of this, the online retail market is highly fragmented. So top 3 players of the Russian online market account for only 19%, and the rest is fragmented online players. So we see that opportunity for growth in the Russian market is huge. So we are focused on growing our business in Russia.
Alexander, do you want to talk to us about consumption patterns in Russia, just how willing many Russians are to make those purchases online? I know that you had to step up and say sporting goods and also child development products during the lockdown, but what are you seeing that gives you the sense that these consumption patterns will shift online permanently?
Well, in March and April, we see number of customers doubled over last year. And on top of this, frequency of purchases has increased substantially. So I would say that Russian customers are ready to buy any goods online, and we see very high growth rate across all categories, including starting from electronics to apparel to FMCG to even pharmaceutical products. So the growth rate, customers are willing to accept online if the quality of service is high. And for Ozon, quality of customer service is extremely important. In May, for example, we have achieved our all-time record in timeliness of delivery and overall quality of service. So as we expand our infrastructure and invest in technology, we see that customers are willing to adopt e-commerce as a service and shift their purchase completely to online.
And in terms of the delivery costs, you offer next-day delivery service, I see, to 40% of people in Russia. We were discussing yesterday with Inditex, the Spanish brand, with some retail experts about the cost of last-mile delivery, the final stretch of that delivery. How do you go about managing this particular part of the costs when it comes to getting these products out to your customers?
Well, here, scale, of course, helps, as we fill our logistics pipe with more goods, with more parcels from different suppliers and different sellers on our marketplace. Cost of delivery goes down. I would say that so far, well, it's hard to say given, as we discussed, the market is highly fragmented, but I think we're one of the most efficient companies in national logistics overall chain.
Alexander, we're going to wrap up. I think we're struggling a little bit with your line here. Alexander, we're going to wrap up with you now, but thank you so much for joining us. Alexander Shulgin, the CEO of Ozone, and apologies for the breaking up audio. Hope it didn't affect your enjoyment of the conversation. We're going to take a break. We'll be back in just a moment. US futures suggesting we will have a negative start to the trading session, and we've gone from a 400-point drop to a 500-point drop in the last hour or so on the implied open for the Dow Jones. We'll be back after this.
Squawk Box is breakfast with the most interesting people in the world.
It's a privilege to get to talk.
Looking to freshen up your listening on TuneIn? Head to the homepage to discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back at the wall. It's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it over to Reese for one, back to Hodges. It gets away from him. Barrows trying to go to second. Hodges.
It's on demand, it's free, and it's only on TuneIn. With the NHL season temporarily on ice, now is a good time to catch up on past games.
This shot scorable, get again. Burns run, he scores!
With game replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter to Cunningham to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search classic game replays to start listening.
It's TuneIn Sports on this day. On this day in 1959, Charlie Sifford becomes the first African-American to play in the U.S. Golf Open.
Charlie Sifford changed the game of golf, one hole at a time. The first black golfer on the PGA Tour had to argue, fight, and even sue, forcing the PGA to scrap its Caucasians-only policy in 1961.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Ready for a one-of-a-kind look at the NFL? On the PFF NFL podcast, Steve Palazzolo and Sam Munson interpret the unique stats of Pro Football Focus to analyze the league, uncover secret superstars, and discuss which teams to watch out for in the next Super Bowl.
Let's talk some football. Let's do it, Steve. All sorts of stuff. We're going to do most improved defenses around the NFL. Solomon Wilcots, our very own. He went into some detail over at PFF.com. Most improved defenses around the
Search PFF NFL on TuneIn to listen.
Are you fully informed on the NBA? On the NBA Hangtime podcast, veteran sports writer Sekou.
Welcome back, everybody. Mario Centeno has resigned from his post as Portuguese finance minister. The move leaves his role as Eurogroup president up for grabs, triggering a succession contest as ministers debate a 750 billion euro recovery package. Let's get out to Sylvia. Where do I send my CV, Sylvia, if I fancy the job?
Well, Jeff, you actually need to be a sitting finance minister in order to be Eurogroup president. So I'm afraid that you can't apply for this job. And on top of that, you're perfect at the job that you have right now. So please don't leave us. But let's talk about who might replace Mario Centeno at the head of the Eurogroup. At the moment, Jeff, there are 3 names floating around. And these include the Spanish finance minister, Nadia Calviño. It includes as well the Luxembourg finance minister, Pierre Gramegna, and finally the Irish finance minister, Pascal Donoghue. But that, as I mentioned before, this decision is happening at a very important context for the Eurozone and the European Union as a whole, really. And that is the discussion over this 750 billion euro package. As you know, there are a lot of divisions within the Eurozone and the EU over how to deploy and how to apply this additional fiscal stimulus. And those divisions could actually impact the vote at the Eurogroup level. I have to say as well that the ministers will actually have to be quite quick in deciding who should be the next Eurogroup chief. That needs to be concluded by the 9th of July. So essentially they have about a month to choose who should replace Centeno as head of the Eurogroup. And a final detail about this vote is that the winner will only need a simple majority. So essentially the finance ministers don't need a consensus view over who to choose, but that's usually the finance ministers try and get as many people on board as possible to avoid showing that they're actually divided over who should lead this important body at the Eurozone level, because let's not forget, we are important crossroads for the Eurozone, and the Eurogroup is responsible for deciding essentially how this money should be applied and how the member states could essentially support the businesses and citizens across the Eurozone. And let's not forget as well that ultimately, though, the decision on the fiscal stimulus is up to the heads of state, and there will be an important summit next week. The heads of state have the final say, so let's see what will come out of the summit next week.
Terrific, Sylvia. Thank you so much, and thank you for the kind words. You can come again. Let's have a look at the European yields then. Well, let's face it, the bond market's not holding its breath, is it, waiting for this 750 billion to be distributed. But what we do have here is a move lower on yields as the market reacts to a risk-off tone in equity markets this hour. It does seem that as investors cogitate on the idea of lower for longer in the United States on interest rates, as we learned from Fed Chief Jay Powell, they've decided that maybe we'll just take a pause and have a little rethink about how much equity we are stuffing in the portfolio at the moment. The European bourses then, let's just have another look at the trade. And as you can see, we are firmly in negative territory right now. So is this a pause in the recent risk-on rally we've had, or does it signal a sea change in sentiment? Steve, what do you think?
I don't know, Jeffrey, and that's being frankly honest. I'm just trying to look at the evidence for the big move up and then the big downtick we've had in the last couple of days. And quite frankly, everything's actually been very positive if you think about it. The jobs figures were really good, so that might have got a more hawkish Fed. But actually, no, what it's had is a Fed that's will come out with an almost Rumsfeldian statement. I'm not even thinking about. Did he have another thinking about? I think it was just 2. Not even thinking about putting rates up until perhaps the tail end of 2022. So, you've got the reassurance from the Fed that the easy money is going to continue. You've got the reassurance actually that the data wasn't quite as bad as expected. So I can only assume that some of those people who have come on our channel have told us that they are long-term investors and through the cycle, and that they're 7-year investors, and they're just not ready to see an opportunity at this level. I mean, let's look at, for instance, the market that I know the best as well, really, the UK market. We're kind of middle for diddle, if you don't mind me using such a technical term. We've been down as 4,900. We've been up at the top height of the year at 7,500 as well. Sitting at 61, 62, it feels a little bit more non-committal than some of the other indices, such as the Nasdaq that you've been highlighting today, Jeff, which has been trading at pretty much record levels. So I think the market's very much on its hands. It is very much dependent on the data as well. And also, just as far as the UK is concerned, what happens on the long shot if we do get some form of Brexit deal? We've had the CBI talking about how companies are just not prepared for no trade deal Brexit. In fact, they're putting all their efforts into fighting the pandemic. What happens to the UK market, for instance, as I was discussing with a fund manager on the street only 2 days ago, if we do get a Brexit deal? Is there a re-rating to the upside, or does it just slavishly follow the other indices around? I think there's a lot of questions, and to say that we know one way or the other where this is going next, I think, that, well, disingenuous, perhaps a little bit not even truthful. I think it's anyone's guess.
Look at the size of the moves on markets. So the German stock market, the French stock market up about 10% for the week. This week so far, we've given back half of that territory. It felt as though investors were just a little bit too optimistic last week, picking up all the good news. Then we had the jobs report to round out the week, and investors thought there were clear signals to the upside. This week, I think a lot of investors are looking for the next sugar rush. Where is it going to come from? And after that jobs report, there was a sense, well, maybe it'll be harder to push through another large stimulus package on the Hill in the United States. Also from the Fed, we didn't get the yield curve control, the anchoring of yields for the long term that investors were looking for. So I think they just turned a bit cautious. And you could see it in the data. To me, it was pretty evident that we're not dealing with a real snapback that's going to happen next year. Sure, the numbers start to improve on the growth side. You know, we get back to growth of more than 5% for next year in the United States, 3.5% supposedly by 2022. But that is low quality growth. And it also tells you a story around the unemployment rate. We're going to be tracking a little bit lower from the 9.3% this year, down to 6.5%, then to 5.5%, then to 4.1%. But it's going to take a number of years to get that unemployment back lower again. And I think it's just a dose of cold water in the markets that are saying, well, we're going to see that recovery come pretty quickly. It's pretty clear, well, it may not take 10 years like the global financial crisis to get back to the starting point, but it is going to take a number of years to recover from this crisis. And that's without even factoring in a second or third wave of infections, Jeff.
Karen, I'll pick up there. I mean, you highlight the economic numbers, but I would throw into the mix the health numbers. And as we discussed with Chris Ralph from St. James Place earlier, the number of new cases is rising in America's West and Deep South. And as far as he's concerned anyway, markets are not pricing in a second wave. And now we're looking at the impact of economies reopening and perhaps some more nerves around what that means for infection rates.
What we need is a super forecast around the table, don't we, to tell us where we're going, because we're all trying to grasp for the future at this point. But we'll see how the markets play it out as we go through the rest of the day here. And at least for the next 60 minutes, you can enjoy the company of Juliana, Steve, and Karen. Me, I'm bowing out at this point, popping down to the canteen for a coffee. That's it for Squawk Box. Street Signs coming up right after this. Thanks for tuning in and stay with the channel.
Going to change dramatically. If it ends up in the ocean, it will dissolve. We have a vision of the zero waste cafe.
Hi, this is Mike Tirico, introducing you to Sports Uncovered, the newest podcast series from the storytellers at NBC Sports that will shine a fresh light on the most unforgettable moments in sport.
The reason why I'm smiling, I might get in trouble for this.
Search Sports Uncovered to start listening today. While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
Did you know that with TuneIn's local radio feature, you can stream live FM and AM stations broadcasting in your area? Discover local news, talk, and music stations. Navigate to the local radio section under Browse to listen locally on TuneIn.
Okay, here we go. With the NFL draft in the books and the schedule set, check out a TuneIn podcast for daily updates on the lead up to the 2020 season. Like the Ringer NFL Show, where a rotating cast of Ringer experts talk with players, coaches, and special guests about the NFL landscape.
A lot of the other teams that we consider...
Or ESPN's NFL Live.
If there are some delays because of the COVID-19...
Search sports on TuneIn to explore these pods and much more.
Are you ready for the realest first-hand take of what's happening in the NBA? On their podcast, All the Smoke, Former NBA players Matt Barnes and Steven Jackson bring their fiery intensity to the mic, dishing on the latest news and drama from on and off the court without boundaries.
Half man, half amazing. My friend, our brother, Vince Carter, man, welcome to the show.
Yo, what's up, man? What's up, my brother? Man,
Search All the Smoke on TuneIn to listen.
As global COVID-19 cases continue to tally in the millions, local and national governments are trying to limit the spread, while scientists race to develop a vaccine.
So we're going to start manufacturing.
The news is always changing. Luckily, TuneIn always has the most current updates and stories, featuring live streams of CNN, MSNBC, Fox News Talk, NPR, the BBC, and more. Plus, the latest episodes of your favorite news podcasts. Search Coronavirus News to hear what's happening now.
Or does a big cash payout right now make more sense for you? Cash to enjoy your retirement, pay medical bills, buy a family vacation home, even make a cash gift to your children. If you're 75 or older with a policy of $100,000 or more, Benefit Advance can give you the money you need to really enjoy your retirement and take care of your health. Learn more about it. Call today, 888-708-4290.
We are the dreamers. We come in a variety of colors
and styles,
a variety of sizes.
We come in different patterns
and different materials.
We are the dreamers.
Achieving your dream can take work.
I just wanted to do a career.
But don't give up.
Changing my life.
Don't ever give up.
Ignore the haters.
They didn't believe that I can do it, and I just proved them that I can.
Independence University.
IU is an online college.
Education online for a better life offline.
So your campus is wherever you want it to be.
Take classes when you want to take classes.
At IU, you receive the tools you need at no extra cost.
Even a brand new laptop and tablet to use in school.
You're going to keep that laptop and tablet when you graduate.
And IU's career services work really hard to help you get a job.
You've got to have dreams. Independence University.
Education online for a better...
Good morning, everybody, and welcome to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. Lower for longer. Bank stocks suffer a sharp sell-off, dragging European stocks deeply into the red after the Fed vows to keep rates near zero until at least 2022, calling this the biggest economic shock in living history.
We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time.
Yields on both sides of the Atlantic fall, with the 2-year UK gilt hitting a record low, while U.S. futures suggest the Dow will open more than 500 points lower. Travel and aviation stocks crowd the bottom of the Stock 600 as Lufthansa warns of deeper job cuts and the broader sector struggles with
takeaway.
The station you're listening to is experiencing technical difficulties.
Shares turn higher as the European food group snaps up U.S. rival Grubhub in a $7.3 billion all-stock deal, beating Uber to the top seat at the table.
Well, a very warm welcome to Street Signs, everybody. It's been a pretty remarkable morning already. Just in the first hour of trade, we've got a substantial sell-off underway here. The Stock 600 currently trading down by about 2.6%. And as you can see behind me, it is really a sea of red. Just over a dozen stocks or so are trading in positive territory, but the bulk of stocks are trading lower this morning. And this comes after the Federal Reserve meeting yesterday, where the Federal Reserve vowed to keep rates near zero through 2022. They forecast about a 6.5% contraction this year. So we are looking at an accommodative policy stance from the Federal Reserve. But investors also eyeing up some fresh infections data out of the United States. We're seeing a rise in the number of new cases, in particular in the West and in the Deep South. So some concerns around the implications of opening up the economy and what easing measures actually looks like in terms of infection rate. So a renewed concern around coronavirus itself from a health perspective, and then subsequently from a lockdown perspective, also weighing on sentiment this morning. Let's take a look at European markets and the individual regions, what we're seeing here. So we've got red across the board. Every one of the major regions is trading lower this morning. We've got the French index leading the way lower, down about 3% now. The DAX down 2.7. Over in Italy, the FTSE MIB is down 2.7 as well. And here in the UK, the FTSE 100 is down about 2.5%. But let's also put these moves into context. Last week, we saw more than 10% worth of gains for several of these major markets. So we are retracing the rally that we saw come together last week. So it's not necessarily all red when we look at a slightly longer time horizon, but clearly a very strong signal from investors this morning. We are in risk-off mode. And on that note, let's take a look at the sectors, because again, fairly telling when we look at the breakdown and the split we're seeing. Very clear trend. We've got to the defensive growth quality parts of the market outperforming this morning, although still in negative territory. So we've got healthcare down 0.6%, the best performing basket of stocks in the market. And then on the downside, we've got banks down 4.7%. Banks have been very volatile in recent days. We saw a pretty big boost to sentiment around the banking sector on the back of comments from Credit Suisse at the Goldman Sachs banking conference suggesting capital markets activity is strengthening. But now we're looking at an environment of lower rates for longer. What that means for margins for the banking sector, that's weighing on sentiment, and as well as these concerns around the reopening of economies on the back of new cases rising in the U.S. We've got autos down 4.6%, another one of the key beneficiaries of the recent cyclical rally. Travel and leisure and oil and gas, that rounds out the bottom part of the stock 600. Now, in terms of the Fed yesterday, let's take a listen to a little bit of sound from the Federal Reserve Chairman. Following the Fed's two-day meeting, Jerome Powell, the chairman, said the central bank is still looking for signs the U.S. is emerging from the, quote, biggest economic shock in living memory.
In March, we quickly lowered our policy interest rate to near zero, where we expect to keep it until we are confident that the economy has weathered recent events and is on track to achieve our maximum employment and price stability goals.
Well, we are seeing a very clear trend in bond markets, yields moving lower on both sides of the Atlantic. The UK 10-year currently trading at 0.23%. Over in Italy, the 10-year 1.5%. And in Germany, the 10-year Bund is negative 0.37%. And this, of course, follows some substantial action in treasuries yesterday. Let's take a look at U.S. treasuries. We saw the 10-year yesterday. The yield on the 10-year posted its biggest drop in 8 weeks. Currently, the 10-year is holding steady around 0.7%. Let's bring in somebody who knows a bit about fixed income, James Athey, Senior Investment Manager, Aberdeen Standard. Steve also hopefully will be with us for this conversation. James, what was your take on what we heard from the Federal Reserve yesterday? The key message seems to be a dovish stance from the Fed, but perhaps the more nuanced comments. What was your take?
Sure thing. Morning, Juliana. Yeah, I didn't think there was a lot to take, to be honest. I definitely felt this was going to be a tricky meeting to forecast, and it was definitely going to be a tricky meeting for markets to digest, because so much has happened so quickly, not just in terms of data, but in terms of Fed policy. So it felt like the right thing for me would be for the Fed to stand pat, to not introduce any new measures, to give us their updated projections so that we can see how they are seeing the sort of material future, the medium-term future. And then it's obviously about the communication strategy around that. And that's where in the past, Jerome Powell has had a few issues just in the press conference. I don't think he really did yesterday. I thought it was an okay performance. But essentially what they're telling us is that there's huge damage to the US economy. Now, if that's a surprise to the investment community, then I really have lost, all ability to understand what's going out there in the world, because markets cheering a payrolls report, which was a huge positive surprise, was almost immediately then sort of walked back a little bit by the BLS who produced those statistics. And even if you took them at face value, what you saw was an unemployment rate 3 percentage points higher than the worst of the post-GFC period. So to me, that tells you that there's a heck of a lot of wood to chop. There's a lot of work for the economy to get back to normal. And I think the Fed has just confirmed that. That shouldn't be new information, but I think for a few market participants, it may be a bit of a cold shower after what's been a quite remarkable risk-on period.
And on that point, I mean, you say that it shouldn't come as a surprise, the Fed's economic forecast. It also comes after we've heard forecasts from a number of other authorities around the world, the ECB, the OECD yesterday. Do you think the Fed's forecasts are realistic? And, what is driving this big reaction in markets if it shouldn't come as a surprise?
Well, I mean, to take the latter point first, what's driving this reaction in markets? Unfortunately, again, we've created a financial market which is thoroughly and utterly addicted to Fed stimulus, and it's been getting a heck of a lot of that recently. And so if you keep giving a kid candy, it doesn't take many minutes of not having a new lollipop before the kid starts crying. And essentially, I think that's what we're seeing this morning. Are the Fed's forecasts realistic? I have absolutely no idea. Economic forecasting is a very, very tricky thing at the best of times. Trying to make 1, 2, 3 year ahead forecasts in this environment, I think is next to impossible. But to me, the key piece of information or the key understanding about how the economy is likely to work is that this sequential growth improvement that we are seeing and likely to see in the near term really doesn't tell us a lot about the medium term trajectory of the economy. And I think where the market has latched onto the idea that really further lockdowns and adjustments in consumer behavior and corporate behavior because of the virus are the main downside risks to the economy. I would argue that actually they may well be downside risks to the economy, but the more material risk to the medium-term trajectory of the economy is the amount of debt and the need to service that debt. And what we're about to experience is another essentially balance sheet recession period where corporates and consumers are required to manage their balance sheet into the future, and that drags on activity.
Right, I'm going to ask you two questions, James. Good morning to you, by the way, my friend. One very quick question. When do you think the economic rally realistically will start? 2022, 2023? Give me just a very quick answer.
Well, it depends how you measure it. If you measure it sequentially, month on month and quarter on quarter, it's going to start this year probably because we're seeing the economy open up. You had zero activity. In a meaningful year-on-year kind of way, yeah, I think you're talking about at least the end of 2022. I think it's possibly going to be longer than that.
All right, okay, good. That's my point. Okay, so I agree with you. I think we've got a very tough 18 months, 2 years ahead, but then we could see some meaningful growth 2022, 2023. So why are you so mean to the investor when all I'm told on this channel day after day by Aberdeen Standard, by every blooming person out there is we're investors. We're there for 5 years. We're there for 7 years. We're there for 10 years. When you've got zero interest rate, why people are putting into the market now is not because they believe there's some quick sugar rush. Surely it's because they're being told by people like Aberdeen Standard, James, that actually over a 5 to 7 year period, they're going to be okay.
When it comes to, it depends which market you're looking at. So obviously I'm a rates guy and a bond guy. They're very cyclical products, and therefore, investing through economic cycles doesn't necessarily make a huge amount of sense because you are investing in a product which should describe the cycle. But when I look at equities today, my concern is that history says when you have valuations as stretched as they are at this moment in time, that there's the potential for very low returns over that sort of 5, 7, 10 year period. I guess the question then is raised, well, what are the alternative assets? And this is where you get into a more subjective conversation about, well, yes, equity returns may not be great over 10 years, but they may still be better than equivalent returns elsewhere because all assets are expensive at the same time. And that's quite a difficult circle to square. And of course, then you have other investors and other investment styles where they would say, yes, over 5 to 10 years, maybe the returns aren't great, but in the next 6 months to 12 months to 18 months where stimulus and policy measures are going to dominate, potentially you can still see meaningfully positive returns from riskier assets. So there's a lot of nuance in the conversation. Being a bond guy, I'm sort of paid to be miserable.
Oh, come, don't you give me, I get that from the corporate bond lot as well. You fixed income lot are always looking at the equity lot as well, because that's how you work out what your valuations are by comparison as well. So I don't want to hear that from you, James. I hear that from all the others as well. Why can't the equities grow into the valuations over a 5 year period?
Do you know what? The interesting thing about the equity market is that looking at it in aggregate, which as a macro guy is what I would do first and foremost, doesn't tell you a lot because the distribution is absolutely critical here. And if you look at the US equity market, which I think is the most overvalued of them all by some margin, actually what you see is that the median stock or the vast majority of stocks don't look anywhere near as stretched as the small number of stocks that have driven this market to where it is. And again, this is the problem with value in growth companies. And if you're in a paradigm shift, value in growth growth companies is even more difficult, is that it's an act of faith. You generally believe that these companies can generate sufficient earnings and earnings growth over the years to make these valuations meaningful. I'm skeptical, but I don't really have a quantitative way of demonstrating that, because that's the very nature of a company whose earnings trajectory it is essentially an extrapolation or a forecast. You don't have enough information to go on. That being said, there are a number of stories out there, and I think we all know about these, which concern me incredibly with the valuations that are being attached to them. A company which had zero revenues in 2019, which is worth 25 billion, to me that there's something incredibly wrong there, and this starts to look like a mania at that stage.
James, that's certainly an important debate and a complicated question there. I want to, I guess, hone in on your specialty. You're a bond guy, as you said, and I was reading some research from Deutsche Bank this morning from Jim Reed suggesting, in his view, the most dovish development out of yesterday's Fed decision was the comments around continuing to purchase, at least at its current pace, the QE program, which amounts to $80 billion in treasuries and $40 billion in MBS per month, effectively suggesting that this leaves room to surprise to the upside. What's your take?
Yeah, I would agree with that. As an investor, the most attractive thing I can find when I'm trying to build positions and portfolios is an asymmetry. If I can get the best of nothing or something, then I want to be positioned there. And if that asymmetry is large and attractive, then I can put a lot of risk to work there. So I think the Fed has just provided that sort of asymmetry, because what we saw was that their daily purchases went from 75 billion a day to 4.5 billion a day in quite rapid order. It surprised me how quickly they tightened up there. And there's always the danger that the market extrapolates and starts to be concerned about treasury purchases waning too far given how much supply we've got. I think the Fed has just done enough in that comment to allay some of those fears. I think that's why we've seen bond yields reacting as they have, obviously assisted by equity market declines. So I would agree with Jim that that's definitely a dovish outcome, certainly relative to possibly some market participants' expectations. But we mustn't forget that there is an awful lot of treasury supply, and we're talking about another fiscal package in the US, and so it's not easy to extract from that where the net supply gross supply argument is going to net out, and we don't really know how reactive the Fed will be in increasing their purchases. That's still a big unknown. So I don't think it's a green light to just go absolutely wild on duration, certainly not after this move, but over the medium term, as Steve said, we're investors, so I still look to the medium to long term. I still think you're being amply compensated for taking treasury duration, and I still think there are huge asymmetries to where treasury yields can go in the future as we deal with these economic and debt issues.
All right, well, let's end on that note. James, thank you, as always, for joining us. James Athey, Senior Investment Manager, Aberdeen Standard. For more on the Fed's latest decision, including a look at the central bank's plans for bond buying, head to our website. That's cnbc.com. And as a reminder, you can follow us on Twitter at Street Signs CNBC, and you can tweet me directly at CNBC Juliana if you want to weigh in on anything that we are discussing on this show. Coming up on Street Signs, Spain's top football league prepares to return tonight. But what state are football's finances in amid the coronavirus? We'll find out after the break.
The station you're listening to is experiencing technical difficulties.
With millions of podcasts dropping new episodes all the time, how do you keep up with all your favorites? TuneIn makes it easy. Simply head to the home screen and find your new episode section to see the latest additions.
The right time with Bomani Jones.
While he was gone, Al had some kind of vote to make him the managing. You remember, he used to come up all the time in the Raiders game that he was the managing general partner. And don't forget, there was a lot going on in Munich. You know how tired that man was to come find out that Al Davis had strong-armed his team from him while he was gone.
Search The Right Time with Bomani Jones to listen.
Looking for your daily fix of NFL news and analysis?
In that. So we had to blow it up and do Super Bowl predictions instead.
Look no further than the Pick Six podcast, where CBS sports writer Will Brinson gets you up to speed with what's trending in the NFL that day, so that you're always in the know.
Yeah, it's pretty revealing of Brince's methodology for predictions. When he gets mad at people for predicting good teams are going to win the Super Bowl or good players are going to win major awards. That's how you wind up.
Search Pick Six on TuneIn to listen.
Who says you can't have a laugh while getting serious about America's pastime? On the daily podcast Locked On MLB, comedian and baseball fanatic Paul Francis Sullivan talks about each team, each pennant race, and everything else in the game, from rule changes and controversies to baseball cards and stadium food.
For those of you who are not familiar with me or the old show, I love to obsess over baseball. I'm talking baseball over the Super Bowl. We had a TV showing the division series during my wedding.
Search Locked On MLB on TuneIn to listen today.
To help keep you and your loved ones safe, TuneIn has the latest guidelines from the CDC. Avoid close contact with people who are sick. Remember, 6 feet. It's the rule. Stay your distance and always wear a mask while you're out. Avoid close contact with people who are sick. For the latest stories and updates on COVID-19, search Coronavirus News on TuneIn.
This is a keepsake frame. This is actually a photo from my wedding. Keepsake is incredibly simple. You just choose a photo that you love. You can preview it in over 100 frames, and in a couple of days, you're going to receive your photo in a beautiful handmade frame.
On Squawk Box, reopening the economy. Real-time numbers on where the action is. Retailers ready for business. Consumers ready to spend. Today, 6 a.m. Eastern. Watch or listen live on the CNBC app.
Welcome back to Street Signs, everybody. Just Eat Takeaway is buying Grubhub in a $7.3 billion food delivery mega deal. The Dutch giant beat out Uber, which approached Grubhub in February. Let's get out to Karen, who has been following this story. Karen, what more can you tell us about this deal?
Juliana, the move will create the largest food delivery platform outside of China. This is a mega deal to effectively seize market share. The deal would mean 2.1 billion euros in combined revenue for the group. In about 25 countries is where their footprint would be, servicing about 70 million combined active customers. So it is a huge combination of assets. Crucially, it is an all-stock deal, and this is very similar to Uber Eats, which was negotiating a deal with Grubhub initially, but has now thought to have walked away because of antitrust concerns. But the stock they'll be using implies a value for Grubhub shareholders for the stock of $75.15. That is above where it traded yesterday, where it closed about $59.05. Also thought to be above the price that would have had an implied value of $67.04 that Uber Eats was offering. So it is a step up. It's a premium to the relative share price action for Grubhub. It did trade around these levels back in 2019, but has been well off those levels since then. In terms of the combination, the management team of Grubhub will stay on and run the North American business. But the two founders of the businesses started out Grubhub and also Takeaway back around the same time, turn of the century, also very like-minded and chasing profitable growth. Now, keep in mind there's been much-needed consolidation in the sector that has really accelerated in recent months. And Just Eat and Takeaway only inked their deal in May this year, finally clearing some of the approval from the UK regulator. So very aggressive that they've now turned around and tried to ink a deal with Grubhub. What it means in terms of the recent trends we've seen in food delivery, clearly consumption patterns have changed, and you've seen a real step up in activity at both of these sites in the United States and also across on European markets. So they've really benefited from that change in the eating at home that you've witnessed, and double-digit increase is what you've seen in both of them. In terms of whether there is any antitrust concerns here, you must keep in mind that Just Eat Takeaway has no US retail presence at all, so it is seen to be clearing regulatory approval fairly easily. So that is worth noting. In terms of what you're also seeing in those trends that I just mentioned on the delivery side, 41% improvement in April and May for Just Eat Takeaway. You've seen an increase of 59% in Grubhub just in those months. If you look at the metrics, what do shareholders do with it? Well, you've seen very choppy action in the share price in trading in Just Eat Takeaway here in Europe. It fell initially. Now it's traded back up. It's bounced in what is a broadly weaker market. So investors trying to work out whether scale matters at this point. I've got to say I think it does, and I wonder whether there'll be more deals in this space with Just Eat, Deliveroo, as some of the others in the sector. Juliana.
Karen, thank you so much for breaking it down for us. I want to stick with the deal space. We've got another deal in focus this morning. The EU will reportedly launch a 4-month investigation into Fiat Chrysler and France's PSA Group. According to Reuters, the move comes after the car makers declined to offer concessions in their planned $50 billion merger to address EU antitrust concerns. Spain's top football league will return to action later today for the first time since March 23rd. Sevilla and Real Betis will clash in Seville with the remaining 110 La Liga games set to take place without fans behind closed doors. Now, the coronavirus pandemic has accelerated the need for behavioral change in English football. That's according to Deloitte's latest annual review of football finance. The warning comes as the accountancy firm warns the virus outbreak will likely accelerate the revenue polarization between and within football leagues around Europe. Let's bring in Dan Jones, partner and head of the sports business group at Deloitte. Dan, thanks very much for joining us on the back of publishing this report. I guess let's kick off with the impact from coronavirus. Based on this report, to what extent do you expect revenues to be hit by the disruption to the 2019-2020 season?
So the report we've looked at is 2018-19 season, so the last year before Corona. And then for 2019-20, it's a slightly complicated picture because what you're having is the football seasons and the club's financial years usually coincide. This year it's not going to happen like that. There's going to be effectively, we think, about $500 million of revenue from the 2019-20 financial year that is permanently lost through rebates to broadcasters, through games being played behind closed doors. And then there's going to be about $500 million that's effectively going to be deferred out of their 19-20 financial year into their 2021 financial year. So the football sector, the Premier League, we think is going to see very much a V-shaped recovery. So about £1 billion worth of revenue that would have normally come in 19-20 not coming in, but then a bounce back in 2021 because effectively you've got 1 1/4 seasons going into that period. And so we'll see a very sharp V-shaped recovery for the Premier League.
Yeah, Dan, I was actually thinking the same thing without seeing the evidence that you guys have accumulated over at Deloitte. Some business models for some sectors, such as airlines, autos, they look broken for a very long time. But the football sector, I can see actually it only going from strength to strength on the back of this because, of course, more people are watching streaming, more people are watching soccer and other sport at home as well. Over the longer term, despite this devastating 1 year, possibly 2 year hit, it's going to be phenomenal, the business, isn't it? So I can't see any change in the relationship between the players or the employees as they are, and indeed the management of these clubs, the ownership, and indeed the fan base as well.
No, I think one of the things that's been evident during lockdown, during the pandemic, has been the extent to which people have craved for things that make a normal life enjoyable, and sport is definitely one of those things. Football's the biggest sport in the world, so the long-term strategic strengths of football are all still there. Not to underestimate the kind of chronic short-term pain that's going on at the moment, but so I think for the Premier League, it'll ride it out pretty well. Obviously, more challenging in the Football League, and particularly when you get down into League One and League Two, where those clubs obviously rely on match day income. So from their point of view, it's really, really tough. If you can't admit fans to the stadium, that business model really struggles. So we're hopeful, of course, when it's safe to do so, that we'll see that level of the game recover as well.
Yeah, and apologies for the English Football League if I concentrate on the Premiership as well. But the business model, we talked about this a lot, of course, when the Glazers took over Man U all those years ago. Is there a real business model there? And my question for you is, does it matter if these Premiership clubs make money or not, given the fact that sovereign wealth has very often, and other buyers very often, ignored the business model just because they want trophy assets over the years?
So I think what we've seen is a move towards a more sustainable business model at the top end, and that's been triggered by a couple of things. New owners coming in who don't want to lose money, the financial fair play regulations sort of taking a bit of heat out of the market, and just the sheer growth in the revenue. It's been an incredible success story for 25, 30 years. There's very few industries who've grown year on year the way that top level football has. So I think that model is becoming more sustainable. Again, if you look below the Premier League, then it's been a bit more reliant on the largesse of owners. But no, I think long term strategically, top division, very, very strong. Definitely some things to work on at the Football League level, but at least the Football League is starting from a very strong place, in as much as that the year we covered 17-18, they had £1 billion worth of revenue among the 72 clubs. They had more revenue at every level, at Championship, League One, League Two, than they'd ever had before, as well as having more money at the Premier League than ever before. So, as I say, long-term strategically, in a very good position. Short-term pain, obviously not to be underestimated.
What about this wage revenue ratio you've highlighted? English Championship clubs increased to 107%. It's a record level. Sustainable?
Well, so we've always said, put an asterisk next to that when we're asked the question, sustainable, because on the face of it, it's not. But you then say, well, you have these windfalls that come in through player sales or through a promotion to the Premier League, which obviously can bail you out. And, of course, you have those owners who are willing to bail you out. So whilst it doesn't look sustainable, they've always managed to do it. The issue now, of course, is that many of those owners, however well-intentioned they are, their core business, the thing they use to cross-subsidise their investment in football, is really suffering. A lot of them are in the leisure industry or in consumer-facing industries. And so simply the losses that the clubs have been making that they've previously sustained, they're not in a position to bridge that gap anymore. And that's why we think the time is probably now right to look at cost control, to look at a salary cap. We ran the numbers for that last completed 18-19 season. And if you had a salary cap in the Championship for that season at maximum of 70% of revenue being spent on wages, which we've always felt is about the right level, then that would literally wipe out the losses pretty much overnight. It represents about a £300 million saving in that season. So we definitely think the time is right to be looking at those sort of measures.
And Dan, you make note in the report that the pandemic is accelerating the need for behavioral change in English football, in the English Football League. What do you mean by that?
So I think it comes down to that cost control point. I mean, as I said, it's been a game of two halves for English football finance over the last 25, 30 years. Phenomenal success on the revenue side, grown the business side, the revenue side, in ways that would have been inconceivable, when the Premier League started. And that's not just been the Premier League, that's been across the Football League, across English football. Great success story at the top line. The issues are around cost control and the bottom line. And those issues are, to a certain degree, inevitable, because what clubs really want to do is they want to win football matches, and therefore they want the best players, and therefore that bids the market up. But it's just about finding that degree of moderation, because these clubs are institutions that have been around long before I was here, and hopefully will be around long after I'm gone. So that's the important thing. It's preserving these clubs for the generations to come. And if that shift is made, I'm actually long-term very optimistic about the future of the football business.
All right, well, let's leave it on that optimistic note. Dan, thank you for bringing us the report and joining us this morning. Dan Jones, partner and head of the sports business group at Deloitte. Still ahead on Street Signs, Lufthansa says it may lay off up to 26,000 people as it weighs the impact of the coronavirus pandemic. We'll have more after the break.
Our company's talent playbook just went out the window.
We need a partner to help us stay ahead.
Who can help us change the way we work?
That's what Kelly does. Companies of all sizes are having these conversations. Kelly can connect yours with the right talent solutions. Visit that'swhatkellydoes.com.
Rising energy costs are frustrating. Electricity rates continue to increase, and there's no relief in sight. It's also smart to prepare for power outages that can leave you in the dark. You need a solution that will help you save money, prepare for power outages, and help the environment. Introducing the Generac Power Cell, a battery storage system that harnesses the power from the sun to help reduce your electric bill and provide backup power during utility power outages.
With the battery storage solution, we're saving about $450 a month.
PowerCell's revolutionary technology captures and stores electricity either from solar panels or the electrical grid. It allows you to use stored energy during peak demand times when electricity costs are high, which helps reduce your electric bill, saving you money. And when a power outage occurs, PowerCell is ready to supply backup power to your home. PowerCell's modular design allows for easy customization for any home or budget. And PowerCell is backed with a 10-year limited warranty.
It was a simple installation, very neatly installed. It was done very quickly and efficiently. Since installing our power system, we've been experiencing a savings of $1,500 a year.
Generac has been a trusted provider of backup power solutions since 1959 and provides 24/7 customer support.
The battery storage solution in combination with the solar has been one of the best investments we've ever made.
Special financing is available with low monthly payment options. you will likely qualify for tax credits and energy rebates, which could save you up to 30%, adding to the savings you'll enjoy over time with PowerCell. Call now to schedule a free in-home assessment. The call is free, the assessment is free, and there's no obligation to buy. Act now to receive PowerView, Generac's home energy monitoring system, a $300 value. With PowerView, easily keep tabs on your energy consumption, monitor your battery usage, and track your savings. Don't wait. Call or go online now. PowerCell. Savings powered by the sun.
Our business hasn't experienced anything like this.
We have to transform our workforce fast.
We need guidance. Who can help?
That's what Kelly does. We can help your business meet this challenge by providing you with the right talent solutions. Visit that'swhatkellydoes.com.
Tonight, your playbook for navigating the new normal, reviving our economy, restoring American business,
Trey Wingo here from ESPN's Golic and Wingo. Every morning, Mike Golic Jr. and I.
The station you're listening to is experiencing technical difficulties.
Welcome back to Street Signs. I'm Juliana Tattlebaum, and these are your headlines. Lower for longer. Bank stocks suffer a sharp sell-off, dragging European stocks deeply into the red after the Fed vows to keep rates near zero until at least 2022, calling this the biggest economic shock in living history.
We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time.
Yields on both sides of the Atlantic fall, while U.S. futures suggest the Dow will open more than 500 points lower as dozens of states report rising cases. Travel and aviation stocks crowd the bottom of the Stock 600 as Lufthansa warns of deeper job cuts and the broader sector struggles with an uncertain return to work. And Just Eat takeaway shares turn higher after the European food group snaps up U.S. rival Grubhub in a $7.3 billion all-stock deal, beating Uber to the top seat at the table. Well, European markets have now been open for about 1.5 hours, and we've got a steep sell-off underway here. More than 2.5% of losses for every one of these major indices. We've got the DAX down about 2.4%, the FTSE 100 down 2.3%, CAC 40 down 2.6%. And this on the back of the Federal Reserve meeting yesterday, where the Fed vowed to keep rates near zero through 2022. But also in the mix here this morning, we've got concern rising around the increase in cases of coronavirus in the United States, concentrated in the West and the Deep South, where those economies have reopened earlier than other parts of the U.S. So some concern rising around a potential second wave of coronavirus infections in the United States, and that's certainly putting a damper on sentiment this morning. Let's get a check on oil markets. So what we're seeing in WTI and Brent, if we can put them on the board there for you, Brent and WTI both trading lower by more than 3%, just around the $40 per barrel mark for both of those. And let's get a check on U.S. futures. Wall Street saw a mixed close yesterday. The NASDAQ closed above 10,000 for the first time ever, a new record high. So investors are putting money back to work in the technology stocks, the growth part of the market, after we had seen a reversal of that trade, a very strong demand for cyclicals in the last couple of weeks. But that trade seems to be on pause now. We're looking at a weak start to trade for all three of the major U.S. indices now. And let's take a look at European banks. This has been a very volatile sector of late. We had seen a rally on the back of some encouraging comments out of the Goldman Sachs banking conference, Credit Suisse weighing in, suggesting that we were seeing an uptick in capital markets activity, and that provided a boost to sentiment for banking stocks. But now on the downside today, we've got European banks down very sharply, and this on the back of the Federal Reserve meeting yesterday and the overall hit to risk sentiment. So a very volatile sector over the last couple of weeks. Let's bring in James Longsdon, Managing Director of Fitch Ratings, to weigh in on the action we've seen in the banking space. James, it looked for a little while there like banks were coming back into favor, arguably one of the most unloved parts of the European market over the last few years amid the low rate environment here in Europe. But now it looks like investors are getting a little bit of cold feet. What's your take on the overall banking sector to start off?
Well, there's no doubt that the European banking sector faces some significant challenges over the sort of short to medium term. Banks are essentially highly geared to the economies they operate in. We're expecting Euro area GDP to contract by 8% this year and still be 3% below end 2019 levels at the end of 2021. And that's in a scenario where the lockdowns are gradually eased and we get economic recovery. Clearly, we see them reimposed, and a second wave of infections, we could see economic contraction being significantly worse than that. So the sort of nearer term outlook, we think certainly from an earnings and asset quality and potentially capital perspective is pretty tough, and it's quite clear that you will get these spouts of market reaction, particularly where things like interest rates, which is such an important driver of earnings, are in question and lower for longer. But I think the primary issues at the moment would be, when we're looking at banks, would be asset quality, absolutely. The NPL ratio going into the crisis of about 3%. Obviously, that will pick up on the back of the economic contraction and rising unemployment and bankruptcies. That will feed into earnings to the extent it hasn't already, of course. We've seen loan impairment charges rise from around about the sort of largest banks. The 5-year average has been about 20 basis points. That went up to 70 basis points. That's sort of in line with the 10-year, the worst point of the last 10 years, I suppose, 2-year average, but still below what we saw in the financial crisis. And of course, what we're going to see now in the second quarter is a fuller impact than we saw in the first quarter on earnings of lower interest rates, reduction in activity on fees and things like that. Perhaps with the exception of the investment and trading banks, they should have a better second quarter in those divisions, certainly.
Within private banking, we're looking now at higher savings rates in several European countries as people have obviously stayed home as a result of the lockdowns and stashed money away for those who've been fortunate enough to hold on to their jobs here. If you combine high savings rates with lower interest rates at this stage, what does that mean for private banking activity and mortgage lending and refinancing in particular?
Yeah, that's one area where we've seen banks certainly getting a notable hit on the I suppose the business volume side. Credit card payment balances and activities notably lower, so that will hit revenues for banks that are active in that. Remortgaging and mortgaging activity obviously lower as well. So that is a clear product of the increased level of savings. So we'd see revenue pressure there on the sort of retail banks, if you like, those income lines as a result of that.
And James, I'd love to get your view on this report out of Reuters yesterday on the ECB considering setting up a bad bank for toxic loans related to the coronavirus, effectively a measure to shield commercial banks in Europe from further bankruptcies and default risk down the line from these companies and households that they've lent to keep the economy going in the way amid the pandemic. What do you think of this conceptually, and do you think it will go ahead?
Well, there's no doubt there's some pretty big backing for this idea in the form of Mr. Enria. He thinks that is a good idea, and he's a pretty important person in the whole discussion, I guess, on this. Look, the good thing about a bad bank is that, the tail risk, I suppose, of a bank holding on to impaired loans disappears. So instead of holding on to impaired loans, trying to work them out, but leaving yourself vulnerable to further reductions in collateral values, instead of that, they're taken off your balance sheet, they've gone, and they've had a pretty successful track record, actually, if you look at what happened post the financial crisis in Ireland, Spain, UK, Germany, where bad banks were set up. But these were all national initiatives. A euro area one will, of course, be trickier because it will hold the whole debt mutualization topic. I think that's probably less of an issue than was the case during the Eurozone crisis, given the more universal nature of this crisis and a clear softening of the stance of some of the northern European countries to things like the EU Recovery Fund idea. But it's a hurdle all the same. So I think this whole issue will, if one is set up, and I think, from a rating agency perspective, these things, taking bad loans off bad books tend to be seen as a good thing in the end. But it'll all come down, I think, ultimately to price. What price will banks be expected or required to transfer these bad loans at? How much will that hit solvency? What are the state aid implications? I don't think so much for the bad bank scheme itself, because the state aid people are pretty pragmatic in a crisis. So that should be pretty straightforward, just the blessing for such a scheme. But what if banks need to raise more capital to cover valuation losses covered by transferring loans? that can raise state aid concerns. If they can't raise the capital themselves, such situations come with burden sharing often, expectations on shareholders and at least some of the junior bondholders. So these are all sort of complex issues that would need to get worked through before such a thing would come into fruition.
Right, that's a great point there on pricing, and when does a bank want to actually make the transfer, given it would mean taking a hit potentially on the valuation of those assets. James, thank you for weighing in on a range of topics in the banking sector. James Longston, Managing Director of Fitch Ratings. Now let's move on to a couple of corporate stories in focus this morning. Unilever has proposed merging its Dutch and British legal entities into one structure headquartered in the United Kingdom. The announcement comes after the consumer goods company failed to move its HQ to the Netherlands in 2018 amid a shareholder revolt. The company said the move would provide greater flexibility for mergers and acquisitions. The Dutch government said it regrets the move, while the UK business minister said it was, quote, delighted. Up to 26,000 Lufthansa employees are at risk of losing their jobs after the German carrier said the roles were, quote, surplus to requirements. Let's get out to Annette, who joins us now with more. Annette, Lufthansa shares are now bouncing off the lows of the morning, but still taking a pretty substantial hit on the back of this news, down about 7.6%. What more can you tell us?
Well, that potential job loss, or those jobs who might have to go a lot more than previously expected. Previously, Lufthansa was saying that more than 10,000 jobs have to go. But now, after that summit yesterday with the trade unions involved, they were stepping out and saying up to 22 full-time equivalent positions have to go. That could well be the first round of negotiations with the trade unions, which are traditionally very strong at Lufthansa and have substantial sway over how the operations might actually be going. Of course, also the pilots are weighing in here, saying they would scrap 45% of their pay to contribute to the rescue package. So I guess everybody is quite aware of the fact, or aware about the situation, or the intensity of the situation Lufthansa is facing currently. No matter what we are going to hear from Lufthansa now in the coming days, they have to come up with a solution by June 22nd, because on June 25th, there's an extraordinary shareholder meeting in which the rescue plan have to get its okay from shareholders. And until then, there also have to be a viable plan what's going to happen in terms of job cuts. Lufthansa is painting a very grim picture about the pickup of demand for air traffic in general, even though they're expanding their capacity quite substantially already by September. They're not expecting a dynamic pickup in demand, and thus they really need to cut their personnel costs substantially, according to management. But that's back to you.
Annette, thank you so much for the detail on that story and your continued coverage on all the twists and turns of Lufthansa. Well, coming up on Street Signs, the Fed pledges to keep rates near zero, warning of the worst economic shock in living memory. We'll have more after the break.
Introducing a new podcast, ESPN Daily, hosted by me, Mina Kimes. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily. Go deeper into the stories of the moment. Get the exclusive access and insider perspective that only ESPN can give you. The best sports story all day, 20 minutes a day, 5 days a week. ESPN Daily.
Search ESPN Daily to listen.
Introducing the all-new Copperfit Energy Socks, the first ever easy-on, easy-off fit to help reduce swelling, relieve tired, achy muscles, and provide energizing support.
Being a SWAT commander, we train to win. The Copperfit Energy Socks, they didn't feel like other compression socks. They totally exceeded my expectations.
Copper-infused fabric woven into our compression sock to help reduce swelling discomfort.
They just slip right on, yet they still have that same compression that you want.
Extra support around the arch and ankle for relief of muscle aches and pains.
These were fantastic. A lot of compression socks are a little too thin. I could wear these every day.
Feel more energized. Get your energy socks now online at GetEnergySocks.com or call 1-800-377-9502. Order now and get a second pair free.
I have so much energy, I can go, hey, you want a dad?
Copperfit Energy Socks.
Nick Bolton here with the latest from Bell & Howell. We call it TacVisor. TacVisor can do things no ordinary visor can do, like block blinding glare without blocking your view, so invisible dangers suddenly become visible, and enhance colors to give you vision as sharp as an eagle's. The secret is Bell & Howell's light filtering technology. Look at that windshield. Tell me what you see. A blank screen? Just a blank screen. Go ahead, put down that TacVisor and take a look again. Wow, what the? That's crazy. Best of all, TacVisor is easy to install in any car.
Act now to get a TacVisor for just $19.99, and we'll even ship it to you free. But wait, order today and we'll upgrade you to our 2-in-1 TacVisor. Just pay a separate fee. When the sun goes down, use the night vision visor to improve visibility and block dangerous glare from oncoming headlights. Here's how to order.
To order, call 1-800-825-9775. Again, that's 1-800-825-9775, or order online at TacVisor.com.
Squawk Alley examines the pandemic impact on business risks, tech advances.
You are seeing it play out in those space names that are publicly traded.
Squawk Alley, 11 Eastern today. Watch and listen live on the CNBC app.
I'm here to ask you to make it stop. Stop the pain. Stop us from being tired. George called for help and he was ignored. Please listen to the call I'm making to you now, to the calls of our family and the calls ringing out the streets across the world.
Powerful words from the brother of George Floyd, who testified before Congress about the need for police reform in America. The comment comes as U.S. lawmakers search for common ground on potential changes. Republicans have denounced growing calls to defund police departments, while Democrats have proposed a ban on chokeholds and the creation of a national database to track law enforcement misconduct. In the tech space, Amazon has announced it's banning the use of its facial recognition software by police for 1 year. The tech giant released a statement saying, quote, "We hope this 1-year moratorium might give Congress enough time to implement appropriate rules, and we stand ready to help if requested." The company added that governments must put in place stronger regulations to govern the ethical use of facial recognition technology. And let's get a check on the healthcare front. The number of confirmed coronavirus cases in the U.S. has topped 2 million, according to NBC News estimates. This after states began to gradually ease restrictions, allowing people to return to work and resume leisure activities. U.S. health officials have urged people who took part in the nationwide protests in the last few weeks to get tested, as they fear numbers could spike as a result of the demonstrations. They also emphasize the importance of wearing face masks and social distancing. U.S. initial jobless claims are expected to slow this week as America's economy continues to emerge from lockdown. Weekly claims are expected to come in at 1.5 million this week. That's lower than the near 1.9 million posted last week. Today's jobs data follows May's record-breaking payrolls report, which showed employment actually increased by 2.5 million. But the jobless rate remains in the double digits. And the big event yesterday, the Federal Reserve policy decision. Officials have vowed to keep interest rates near zero until at least 2022 to help support the U.S. recovery from the coronavirus pandemic. At their latest two-day meeting, policymakers voted unanimously to keep rates steady at between 0 to 0.25% and continue with bond purchases. The central bank also unveiled its first economic forecast since the outbreak began, saying it expects U.S. growth to contract by 6.5% this year. Unemployment is seen hitting 9.3%, with the Fed adding that it will take years for joblessness to return to pre-crisis levels. Let's take a look at the dollar and where we stand in currency markets. We've got currently the euro firming up versus the dollar, trading around 113.77. Sterling, meanwhile, trading on the back foot versus the dollar, down about 40 basis points, 126.92. In terms of the dollar index more broadly, yesterday that index fell by about 0.3%. Its ninth negative session in the last 10. Karen, I think hopefully you're there with me now. I would love to discuss what we heard from the Fed yesterday. I mean, Powell, he mentioned uncertainty many, many times. He didn't really commit to too much. He didn't really commit to too much, I guess, is the bottom line, but rather just asserted that the Fed is there for the long haul. They're not going anywhere. They're just going to be accommodative in the times ahead. I mean, what was your take on the overall message from Powell yesterday?
Well, I thought the projections were quite interesting as to where the economy is going, because they looked very similar to what the ECB was forecasting for the Eurozone. Once we get past this year and we start talking about the recovery, roughly what you expected to see now in the United States versus here in Europe, roughly about 5% growth next year, and then a spike of near on 3.5% the year after, slightly less in Europe's case. So there's an air of credibility almost when you hear both central banks saying what they expect. That said, the reaction from economists this morning, I was looking at some reaction from Paul Donovan from UBS, and he said the wild card on any recovery is animal spirits. We still don't know how businesses and how consumers are going to behave, particularly if we've got a second or third wave of infections, and who knows what else is happening politically, Juliana.
Great point in terms of how consumers are going to come out of this crisis. We obviously are looking at higher savings rates across many developed economies. And yesterday we were speaking to IATA, the general for the aviation industry, that industry trade group. And, you know, we're seeing a pretty strong demand for air travel as the air routes open up. So interesting early indication of how consumers might feel about getting back to normal. Let's get to John Velas, Director FX and Macro Strategy at BNY Mellon Markets. John, what is your take on the action we've seen in the dollar? We've seen the dollar index now in steady retreat for the last couple of weeks, and now we've heard from the Federal Reserve that they're going to be dovish for the foreseeable future. What do you expect from here for the dollar?
I think exactly what you said, that we'll see a continuation of this weak dollar trend, for the duration of the crisis since, the middle of March until, as you said, a couple of weeks ago, the dollar was sort of the currency of choice. We had excess dollar demand, which required the Fed to open those swap lines. Now that we've got a more constructive story for the euro, that's sort of the first crack in the dollar. We've seen dollar Asia weaker. We've seen euro dollar stronger. So I think the dovishness on the Fed and their willingness to keep rates basically near zero, at least out to 2022, is certainly going to take some more of the sting out of the dollar and keep it on the back foot.
John, the forecast suggests that we'll be heading in the right direction in terms of recovery once we get past this year, even though it may be a low quality of recovery for some. What's the bridge there to the possibility around negative interest rates? Because we didn't hear much about that yesterday, and these forecasts, well, let's just see whether they play out. Do you think we can categorically rule out any move into negative rates based on these projections we have from the Fed?
In short, the answer to your question is yes. I think short of the chair coming out, and there was no question asked in the presser this time around about negative rates, which I was a bit surprised at. But I said that short of saying over my dead body, never in a million years will we see negative rates, the market will still hold that possibility open. But central banks don't ever rule anything entirely out, even though maybe in the back of their minds they know it's not going to happen. But the Fed is, for a variety of reasons, including the money market mutual funds as well as the banking system, I don't think we'll see negative rates in the United States unless there's a clear reason that the Fed would really want to weaken the dollar. The Fed doesn't normally intervene to take actions on behalf of trying to target a dollar level. So I think we can pretty much dismiss the idea of negative rates in the U.S., especially after the experience we've seen in Japan and Europe. They haven't really done much other than to weaken the banking sector further.
Right. Speaking of targeting, let's talk about yield curve control, because we didn't get that messaging from the Fed yesterday. And there was a fear in the markets that if you had too much of a positive move in terms of providing guidance, that you might set another risk-on rally adrift in the markets. What do you think of that? Do you think the Fed's cautious about asset bubbles?
I don't think that, it was interesting. There was one of the last questions that was asked at the press conference was, has your actions contributed to further wealth inequality by raising asset values? And he pretty much categorically dismissed the idea of asset valuations being part of the Fed's reaction function, and specifically said, our mandate is unemployment or employment and inflation. And we don't try to target or, interpret what the correct asset prices ought to be. In terms of yield curve control, I was also surprised that he volunteered the fact that they thought about it. They looked at the historical and foreign experience elsewhere in the world, and right now they don't seem appropriate. But I don't think they're off the table for the rest of the summer. Probably we might see something like that in September.
All right, John, thank you very much for joining us. John Velas, Director, FX and Macro Strategy, BNY Mellon Markets. Well, that's it for me. I thank you very much for watching Street Signs. We'll give you a look at U.S. futures as we head to break. You can stick with CNBC because Worldwide Exchange is coming up next.
Brian Windhorst Windhorst and the Hoop Collective podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were projecting to be worth $240 million this summer. Well, if the salary cap drops, and even if he's wonderfully happy in Milwaukee, it may make no sense for him to sign when he can just wait a year and wait for the revenues to recover and then lock in.
Subscribe to Brian Windhorst and the Hoop Collective.
Search the Hoop Collective to listen.
You can be with a Generac home standby generator.
24 days we were without power. I had water, I had ice, I had coffee, I had air conditioner. I was able to stay here because of Generac.
When an outage occurs, your Generac home standby generator automatically powers up, so your life goes on without disruption. You and your family are comfortable, safe, and secure. Generac generators run on your home's existing natural gas or propane. And Generac's standard mobile link remote monitoring system keeps you posted on operating status, maintenance updates, and more. Generac generators are designed, engineered, and purpose-built in the USA. Generac is the #1 manufacturer of home standby generators in the world. 8 out of 10 home generators are Generac, with thousands of satisfied customers.
Very good product. Very, very good reviews from everybody.
Prices start at just $19.99. And special financing is available with surprisingly affordable monthly payments. Call now to schedule your free in-home assessment with one of Generac's 6,000 nationwide dealers. The call is free, the assessment is free, and there's no obligation to buy. Plus, if you act now, you'll receive a 7-year extended warranty absolutely free. That's a $695 value. Call now, so the next time there's a power outage, your home powers up. Power your life with Generac. Call or go online to schedule your free in-home assessment today.
Nick Bolton here with the latest from Bell & Howell. We call it TAC-Visor. TAC-Visor can do things no ordinary visor can do, like block blinding glare without blocking your view, so invisible dangers suddenly become visible, and enhance colors to give you vision as sharp as an eagle's. The secret is Bell & Howell's light filtering technology. Look at that windshield. Tell me what you see.
A blank screen?
Just a blank screen.
Go ahead, put down the TAC-Visor and take a look again.
Whoa, what the?
That's crazy. Best of all, TAC-Visor is easy to install in any car.
Act now to get a TAC-Visor for just $19.99, and we'll even ship it to you free. But wait, order today and we'll upgrade you to our 2-in-1 TAC-Visor. Just pay a separate fee. When the sun goes down, use the night vision visor to improve visibility and block dangerous glare from oncoming headlights. Here's how to order.
To order, call 1-800-825-9775. Again, that's 1.
The station you're listening to is experiencing technical difficulties.
There's not enough Black representation in research and development in pharma and biotech companies. I need to invest in the education. Like 23andMe ourselves, we need to have intern programs. What are ways that we can support that kind of growth?
We want to be, by the year 2025, 30% of our executive talent that would be at the vice president above going through the boardroom would be minority talent.
This time should be different. This time has to be different. Let this not just be another stop by another grave marker.
It is 5 a.m. in a reopening New York, and your top 5 at 5 starts with a 6 and a potentially 600-point drop for the Dow. Futures down 625. Investors potentially spooked by some growing virus numbers across America. Also, the Fed factor. Jay Powell and company keeping their foot on the gas pedal. No sign of a rate increase through 2022. That could be bad for the banks. In the meantime, Apple and Microsoft becoming the first two stocks with $1.5 trillion market caps. Wow. Delta Airlines taking steps to raise capital. It is dealing with travel uncertainty, and Amazon stepping into social justice, banning police use of its facial recognition technology. It is a very busy Thursday, June 11th, and this is Worldwide Exchange right here on CNBC. Well, good morning, good afternoon, good evening, and welcome from wherever in the world that you may be watching. I am Brian Sullivan. Thank you very much for joining us on what is no doubt going to be a very busy Thursday, and one that could be a tough Thursday for stocks and investors. Dow futures, look at the bottom right of your screen, are down 635 points right now. Perhaps some believing the reopen rally may have been overdone. Also, potentially some worrying case trends data in Texas and other states that have reopened. Remember, health data is the data to watch right now. Texas has seen about a 2 to 3% daily growth in cases, not that outline of the last couple of weeks, but a slight uptick in there and a couple of other states like Arizona, and that has got people on edge. Now, the bond market yields actually been falling just a bit, reversing a recent trend. Of course, bonds will be sensitive to the Fed. The 10-year yielding 6.69%, we'll call it. Oil prices, like stock futures, they're down as well this morning. You've not only got any kind of growth concerns, but you've got inventories growing in some parts of the world. And if virus cases do start to spike, we could see gasoline drop again as kind of people retreat from any reopen. All this, of course, as the Fed yesterday saying that rates will stay low for years. Bank and financial stocks taking it on the chin Wednesday. The XLF down more than 3%. Every single major bank stock did fall yesterday. Wells Fargo down nearly 9%. Wells Fargo, the biggest mortgage holder in America, and it may be supplanting Boeing, perhaps, as the most important macro stock in the country. Wells Fargo down another 6% right now. Wells, a name to watch. All right, speaking of Boeing, that stock also down sharply this morning, down perhaps 7.5%. You are seeing a trend that we are seeing stocks that are sensitive to a reopening, sensitive to economic growth, sensitive to us getting out, getting on a plane, getting around. They are down right now, along with the price of oil. Similar story overseas. Red arrows in Asia and in Europe. Japan's Nikkei closing down 3%. The Hang Seng off more than 2%. We are also solidly in the red across Europe. You can see France down 3%. Germany down 2.5% as well. Well, as we just said, health data and COVID headlines could be a major factor for the market. They certainly have been and could remain so. This morning, a new and potentially positive headline in the race to develop a treatment. Rahel Solomon is here now with that and some other top stories on this Thursday. Rahel, good morning.
Hi, Brian. Good morning. So the chief scientist for Eli Lilly says that the company could have a drug to treat COVID-19 authorized for use by September. In an interview with Reuters, he says that it really just depends on whether all goes well with either of the two antibody therapies that the company is testing. Lilly is also doing preclinical studies of a third antibody treatment that could enter human trials in the coming weeks. He also says that therapies could beat a vaccine to widespread use as a treatment for COVID-19 if they prove effective. So certainly some potentially good news there. Delta Airlines announcing that it's issuing new debt to raise an additional $1.25 billion. Earlier yesterday, the carrier said that it expects second quarter revenue to drop 90% as capacity is down 85%. It hopes to stop losing cash by December. It has raised more than $10 billion in funds since March through new debt and the CARES Act. Delta has added 100 domestic flights to its schedule this month. And Disney plans to reopen Disneyland and California Adventure on July 17th. That is pending approval by state and local authorities. But guests will need a reservation to enter the parks, as Disney, of course, wants to try to limit capacity to maintain social distancing. Experiences such as parades, which, of course, draw large crowds, and meet and greets with Disney characters, Brian, they're going to be suspended for the time being for obvious reasons, but also perhaps some good news for Disney lovers out there. I'll send it back to you.
Yeah, maybe. And listen, as the father of a 5-year-old that unfortunately takes after his father, which means he runs around and yells a lot, it pretty much is impossible to tell a 5-year-old, hey, don't go over there because there's a pandemic. They just want to hug everybody.
Yeah, I don't know that 5-year-olds understand socially distancing, but you can try.
Or maybe mine is just ignoring his father. Rahel Solomon, we'll see you in a bit. Sure. Thank you very much.
Sure.
All right, let's get back now to the markets. And could the reopening euphoria be over, at least for now? The Dow and S&P coming off back-to-back losing sessions. And look at the futures. They're down 600 points right now. Ouch. Fed Chair Jay Powell telling investors yesterday the recovery will take some time.
We're not thinking about raising rates. We're not even thinking about raising rates. So what we're thinking about is providing support for this economy. We do think this is going to take some time.
All right, joining us now is Invesco Global Market Strategist Brian Levitt. Brian, good morning. Listen, not going to make too much about 600 points of the Dow or yesterday. I mean, 2 or 3 days, your investors, your clients, They are medium and long-term investors, but still, we are in a market that appears to be, if not priced to perfection, maybe pretty close. You got some case trends ticking back up. What is your take on the fragility or the strength of the stock market right now?
Yeah, I always thought that this would happen in three phases. So you have the first decline where sentiment is just really ugly. You get a retracement up. I think I was a little bit surprised by how significant the retracement up was. And then you tend to retest if you get some negative catalyst. And it seems like cases rising could be that negative catalyst. I don't want to, to your point, near-term volatility doesn't mean that we want to be out of these markets. I think what's more important is which parts of the markets do we want to be in, and how do we want to be positioned over the next couple of years? We know we'll ultimately get through this. We know from Jay Powell that interest rates are going to be low indefinitely. That should create a good environment for equities over the next few years. But near-term volatility was always likely to emerge.
Yeah, I mean, listen, it is. We've learned a lot about ourselves, about the world, about sort of the surprise element of things like, pandemics, Brian. We've also learned that all the data we used to look at all the time, all the sort of the standard data points, may not be our best indicators right now. We've plucked out all this stuff on open table and traffic. What are you and your team looking at to try to really gauge what's going on with the underlying economy?
Well, the first thing we look at is the 7-day moving average of the cases. And so you saw it compress in Asia first. You saw it start to come down in Italy. In the United States, it's plateaued. So you're looking for that compression. You also then look for signs that there's some inflation expectations starting to emerge and financial conditions are easing. So we'll watch things like the dollar. We'll watch things like credit spreads, watch things like the shape of the yield curve, all which has been improving. And then to your point on the economic data, there are things you can watch like the mobility index from Apple. You can watch, Google searches on unemployment and how to get benefits. You can watch things like Open Table that are all going to give us real-time looks in terms of how the economy is doing. The reality is, as those mobility indices go up, it's a good sign. It's a good sign for economic activity. It's a good sign for earnings in the future, but we have to make sure that the cases stay either plateaued or begin to compress. If that doesn't happen, then obviously this recovery is going to be halting, which is why you see, to your point, the economically sensitive or early cyclical stocks not performing well today or the last few days.
Yeah, and obviously neither of us, Brian's, are doctors, but, we can all track numbers as well. And I track 15 states and have been really for a couple of months on a spreadsheet. And the good news is New York, New Jersey, the average is about 0.25% in terms of growth. That's good. The bad news is in places like Texas and Arizona, you're looking at 2 and 3%, perhaps air conditioning, people coming back inside because it's so doggone hot. And we know that inside is a lot worse than outside. You don't have to be a doctor to look at numbers and say, okay, that's going up. Is that the kind of stuff you're watching for right now? And if it does continue to tick up a little bit, what do we do?
Yeah, that is the type of stuff that we are watching, and it was always going to be the issue that we know that isolating and social distancing can work. We've seen it where I'm sitting in New Jersey. We've seen it in New York, but as Americans start to think about reemerging, you're seeing the cases pick up. So what do you do? Look, as an investor in the near term, if there's going to be a rise in cases, expect all that you would expect in that type of environment: stronger dollar, lower interest rates, defensive stocks outperforming. But remember, what also won during that environment were the true growth companies. And, it's positioning your portfolio to be exposed to those companies who can take advantage of this type of opportunity, who are well positioned for this type of opportunity, who will do well in a halting recovery. What was surprising to me over the last few weeks was the widening of breadth of this rally to include the early cyclicals, and that's probably what got a bit ahead of itself. The companies that are positioned for the long-term structural changes in society will likely to continue to do well in this environment.
Brian Leavitt of Invesco. Brian, best to you, your family, and everybody. Thank you very much for joining us on an important day. Markets down 600 at least in the futures. Brian, thank you very much. All right, when we come back, no industry has been hit as hard by the pandemic and lockdowns as travel and leisure. But in the gloom, there is always longer-term hope. We'll be got some names that you might want to consider with a top analyst. But first, as we head to break, let's check out some of this morning's biggest pre-market movers with futures solidly in the red. There are stocks, like Jim says, there's a bull market somewhere all the time. And Intuitive Surgical, well, it's up 2% right now. Not a big move, but hey, when futures down 600, look for the green where you can. We're back right after this.
The Woj Pod with Adrian Wojnarowski.
Doris, you had reason to believe that you needed to get a test for the coronavirus.
Right. Well, let's just start with the headline, which is I did test positive for COVID-19. I was so tired from Saturday the 14th through Tuesday, March 17th. I kid you not, I could not be out of bed for 5 minutes without needing to go back to bed and lay down.
Search the Woj Pod to listen.
Things are changing fast. Our business needs people with the right skills.
But who can help us find them?
That's what Kelly does. We'll help connect your business with the talent you need. Visit that'swhatkellydoes.com.
On Squawk Box, reopening the economy. Real-time numbers on where the action is. Retailers ready for business. Consumers ready to spend. Today, 6 a.m. Eastern. Watch or listen live on the CNBC app.
In an era where we're afraid to touch cash or hand over our credit cards or type on a potentially COVID-encrusted keypad, Cheddar, Apple's Pace contactless technology has become a necessity. Honestly, watch or listen live on the CNBC app.
Meet Gravity, the original weighted blanket for sleep, stress, and anxiety. Gravity is the only weighted blanket demonstrated to improve sleep and reduce stress. Now available in cooling for summer.
Have you heard? Home Chef is the only leading meal kit with oven-ready meals. And with new menu options available each week, Oven Ready is a deliciously simple dinner solution you've got to try. Want to hear more? Every oven-ready meal arrives with pre-chopped ingredients in a ready-to-cook tin that makes cooking and cleanup easy. So say goodbye to cleanup duty and hello to oven-ready meals. And new recipes every week. Get $30 off your first month at homechef.com. Home Chef, delicious meat simple.
This is a crate from KiwiCo. Each crate has an awesome science, art, or engineering project inside. Parents can order online and it ships right to your door. Learning has never been so fun or convenient. Get 30% off. Visit trykiwico.com.
All right, welcome back. Well, if you are just waking up, hold on to your hats. Maybe grab a stronger cup of coffee as well, because stock futures, they are down big. In fact, the Dow futures down about 600 points right now. And you need to watch two sectors really today, really watch the markets. But overall, you got to watch financials and energy. Financials make up about 11% of the S&P 500 weighting. They were hit hard yesterday on concerns about low rates. Remember, they need the spreads, credit spreads, net interest margins to widen up. If we stay low in rates, maybe zero or just a couple of ticks for another 2 years, as Jay Powell suggested, going to be harder and harder for banks and financials to make some money. Also, energy, oil backing off again today. Oil stocks slammed yesterday as well. Just two things you got to watch in a market solidly in the red right now. Well, no sector knows more about red and stock losses as much as the travel and leisure sector. Many stocks down 60, 70% over the past month or past year, rather, on some real concerns about companies' long-term survival. And even though some of the virus data the last few days has been concerning in some states, investors generally trying to look past the pandemic. Carnival, Royal Caribbean, Norwegian Cruise Lines, Marriott, Wyndham, and Hilton, all up triple digits from their 52-week lows. In fact, Norwegian, the best performing stock in the S&P 500 over the past couple of months. Joining us is Patrick Scholes. He is Managing Director and Lodging and Leisure Equity Research at SunTrust Robinson Humphrey. Patrick, thank you very much for joining us. You know, we're talking right now about a macro market that may have gotten ahead of itself. Did some of the names that you cover get ahead of themselves in terms of the euphoria and optimism around the rapidity of a rebound and a reopen?
Oh, absolutely.
my space is right at the epicenter of that, especially with the cruise lines. Like you said, some of these stocks have doubled, if not more, which is quite surprising. Given that, especially with cruise lines, the sailings continue to keep being delayed later and later into the year. Originally the cruise lines thought June they're going to sail. Now it's August. Now it keeps getting pushed back. And during this whole time, these cruise lines are just hemorrhaging cash. So that's certainly not a positive, at least for the near term for them.
Yeah, what happens if they keep pushing it back, Patrick?
Well, they keep burning cash, and they may need to go back to the public markets to raise cash. The good news is the public markets have been very accommodating and receptive for these companies to raise cash, though it's been at either dilutive equity or 12% interest rates. But the market has been very receptive. That's the good news. Bad news, it's dilutive equity and 12% plus interest rates, and you're burning a significant amount of cash every month that you're not sailing. Very high fixed cost industry.
And we're seeing a lot of activity in names like Carnival. Number one, it's kind of interesting, Patrick. A lot of buyers on, say, the Robinhood side, right? The smaller retail buyers that are kind of rolling the dice. But you've also the Saudi investment fund take a big stake in Carnival and other big players. So it's interesting. You got small players and super huge players who are coming into these types of stocks. If they had to pause cruises for a few more months, will they survive, Patrick?
Will the cruise companies themselves survive? Yeah, I think they will survive. But again, you're going to be burning millions and millions of dollars of cash every month that you're not sailing, and you'll have to take on more expensive debt. Somewhere in the order probably of 12% range, which certainly, if you're going to value a company on EPS, which we do for the cruise names, that is certainly detrimental to earnings.
Just quickly, Patrick, but we like to end always on a positive note. Any stocks in your universe that are a good buy right now?
I'm going to give you two names here. When we look across the greater travel universe, the demand the green shoots that we see are definitely the drive to domestic leisure. And there is no sector or subsector within travel and leisure better exposed to that than, surprisingly, timeshare resorts. Most of the resorts are drive-to, they're domestic, and they're opening back up. The two names within timeshare that are my favorite are going to be number one, Marriott Vacations, and Wyndham Destinations. Marriott Vacations, VAC, Wyndham Destinations, WYND. So well exposed, or best exposed to the few green shoots that we see.
All right, maybe some optimism out there. Could be a very tough day for this. Been a tough year, by the way, for your sector. Patrick Scholes, appreciate you joining us, buddy. Thank you very much. You have a good one. All right, coming up, companies are making bold promises about greater diversity, but there is a long, long way to go. We're going to talk about what's working, what's not, and what needs to be done. Also, stay focused on these markets. As we said, grab a cup of coffee. Dow futures down 536. We're back right after this.
Today's big number, $130 billion. That's how much of the Paycheck Protection Program has not been loaned out yet. A total of roughly $530 billion in small business aid has been dispersed since April. Today's big number is sponsored by Comcast Business, committed to keeping you and your business connected.
Land Rover, above and beyond. Need better sleep? Try Nature's Bounty Sleep 3, a unique tri-layer supplement that calms you, helps you fall asleep faster, and stay asleep longer. Great sleep comes naturally with Sleep 3, only from Nature's Bounty.
can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Tommy John is comfort reimagined for men and for women.
We use soft, breathable, lightweight fabric with stay-put waistbands that never dig and stretch where you need it. We made a women's line so comfortable there are no visible panty lines and no wedgies, guaranteed.
Go to TommyJohn.com right now to see all that Tommy John has to offer. From the most comfortable and breathable underwear on the planet to the most luxurious loungewear and clothing you've ever felt. For a limited time, get 25% off site-wide. Plus, we'll ship it to your door for free.
Some small businesses don't have storefronts. Their office is a truck, and their workplace is your home. You won't find them on Main Street. But for over 20 years, you've been able to find them on Home Advisor. Book the best local pro for any home project, online or with the app.
When allergies attack, the excitement fades. Allegra helps you say yes with the fastest non-drowsy allergy relief. For 24-hour relief from your indoor and outdoor allergies, say yes to life's possibilities. Allegra, live your life, not your allergies.
Need better sleep? Try Nature's Bounty Sleep 3, a unique tri-layer supplement that calms you, helps you fall asleep faster, and stay asleep longer. Great sleep comes naturally with Sleep 3, only from Nature's Bounty.
All right, welcome back to Worldwide Exchange and good Thursday morning. I guess Dow futures, they're down 531. If you want to find a little bright light, we all do as the sun comes up on the east coast of America, it's that Dow futures are 100 points off their lows. At one point earlier in the show, they were down 630 points right now. Still something to watch. The price of oil also on the slide. Oil down about 3.7%. Some concerns out there. You just heard our guest talk about how Carnival's pushing off, reopening some of its cruises, if you will. Watch the health data. Watch some state growth trends. Arizona, Texas, South Carolina. Watch those states. People get spooked. They might back up. Markets could back up as well. Dow futures off 500. All right, making headlines also today. Amazon says it is banning the use of its facial recognition software by police for 1 year. The change comes as technology companies are facing pressure to respond to the killing of George Floyd by a police officer in Minneapolis. In a statement, Amazon said it has, quote, advocated that governments should put in place stronger regulations to govern the ethical use of facial recognition technology. And in recent days, Congress appears ready to take on this challenge, end quote. Earlier this week, IBM said it was getting out of the facial recognition business altogether. All right, well, corporate America continuing to pledge millions or hundreds of millions of dollars to help fight for social justice. Late yesterday, Adidas announcing it is upping its donation to related causes to $120 million over 4 years. This coming after facing criticism for its own lack of diversity. The announcement put it right between Nike, Sony, Walmart, and our parent company Comcast for the largest donations to date. But despite the recent push for social change and decades of promises around gender and racial equality, progress in corporate America has been lackluster at best. Joining us now to talk about this is CNBC.com reporter Pippa Stevens. Pippa joining us this morning. And Pippa, it's an important topic. It's an important story. Look forward to reading your piece, which is available right now on CNBC.com. You've been talking to people. I think the first and most important question simply is this. We can throw money at the problem. That's a start. What else can these companies do?
Hey there, Brian. Good morning. And yeah, that really gets to the heart of the issue. Throwing money at the problem is not going to solve the systemic racism that exists across corporate America. We continue to see that minorities, both women and ethnic and racial minorities, are underrepresented in the top and leadership positions at companies across America. So companies really need to act and really put actionable initiatives behind their claims of promoting diversity and inclusion. So rather than making just empty promises and blank statements, they need to install programs and re-examine things like their hiring practices, their promotion panels, their compensation evaluations. All of these things where the system has proven in the past to break down. We see that women and minorities are not promoted at the same rate as their white male colleagues. And so each level of the system needs to be examined for why this is happening, and a greater push to make corporate America reflect the country at large.
Yeah, and listen, Pippa, you and I have worked together a lot in the last year. You're my brains on the ground, by the way, talking about ESG. We go to OPEC. You and I talk about energy a lot together. We focused in ESG so much on the E, the environmental. Maybe we've forgotten enough about the S, the social. How does that factor into this?
Yeah, that's a great point, because when the majority of people think about ESG, there really has been a huge emphasis on the E, to your point, and on how we can fix the climate crisis. But now, in the wake of coronavirus and the protests that are sweeping across the nation, the people that I've spoken to say that the S and the G really are going to become more important. And companies are going to be scrutinized on just how they handle racial issues and gender and minority issues going forward. And one of the problems is that at present, companies don't need to disclose this data. So As You Sow is one of the shareholder advocacy groups that is pushing for greater transparency. Investors are demanding it, employees are demanding it, and particularly millennials and Gen Z, as they become a greater portion of the workforce, they are really willing to fight for their values and to take action and to hold companies accountable for their policies, for their initiatives, for inclusive work environments. So that S&G really is set to become ever more important within the growing importance of the ESG movement, which in the first quarter saw record inflows of over $10 billion despite the coronavirus pandemic taking hold in March.
Yeah, and very quickly, Pippa, there's some good news in this. Here's what's cool about it, too. It's not only the right thing to do, it pays off. You've got some data that companies that are more diverse in their boards do better.
Exactly. This should come as no surprise that when you have diversity at the top of a company, diversity throughout the ranks of a company, you are exposing yourself to more thoughts, to more thought processes and better decision making. The data shows that if you have only one subset of society making these decisions, you're subject to groupthink and you can stifle innovation. And McKinsey found that companies that rank in the top 25% in terms of racial and gender diversity are 12% more likely to outperform their peers. So the data really is there. It pays to diversify your ranks. It pays to have an inclusive corporate environment.
Pippa Stevens, thank you very much. Pippa, really important piece. And by the way, I urge everybody to check it out. Pippa's investigation on the issue available now on CNBC.com. Pippa, have a great day. Good to see you. Take care. All right, coming up, a sell-off underway this morning. Dow futures, they're down 540 right now. We'll talk about some of the big drivers with a man who called the rally. What does he see now? Craig Johnson of Piper Sandler will be your guest. But as we head to break, check out some of the biggest Dow losers right now in the pre-market. And there will be some. You got Boeing off nearly 7%. Raytheon, ExxonMobil, they are down as well. And we are back right after this.
My name is Christine Payne. I'm an associate here at Amazon. Step into the blue line, sir. This device is giving us an accurate temperature check. You good to go? I have to take care of my coworkers. That's how I am. I have a son. And he said, one day I'm going to be like you. I'm going to help people. You're good to go, ma'am? I hope so. This is my passion. If I can take care of everyone who's sick out there, I would do it in a heartbeat.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Imagine helping their teeth become 4 times stronger, preventing cavities up to 40%. Act Kids Fluoride Rinse. Stop imagining. Start acting. And now, get anti-cavity protection in new, dye-free iced formulas.
Squawk Alley examines the pandemic impact on business risks, tech advances.
You are seeing it play out in those space names that are publicly traded.
Squawk Alley, 11 Eastern today. Watch and listen live on the CNBC app. Tonight, your playbook for navigating the new normal, reviving our economy, restoring American business, renewing hope for our communities. A CNBC special report tonight, 7 Eastern. Watch and listen live on the CNBC app.
Meet Gravity, the original weighted blanket for sleep, stress, and anxiety. Gravity is the only weighted blanket demonstrated to improve sleep and reduce stress. Now available in cooling for summer.
Home Chef makes home cooking simple and delicious. And with fresh ingredients and easy recipes delivered right to your door, anyone can cook. That means you. You conscientious chef, ever balancing freshness with flavor. You parents, who are overwhelmed by making every meal. And of course, you variety seeker, always on the hunt for new and delicious tastes. Yes, we're talking to you. So, are you ready to give Home Chef a try? Get $30 off your first month at homechef.com. Home Chef. Delicious meets simple.
We are KiwiCo, and we deliver hands-on STEM projects designed to inspire young innovators. Kids of all ages can explore science, engineering, art, and more. Get 30% off. Visit trykiwico.com. Must be 18 or older to log on.
Breaking news on this Thursday morning. Stock futures pointing to a big drop at the open. Dow futures up more than 500 points right now. And let's bring in one of our favorite guests, well-timed, and a man, by the way, who does not nearly get enough credit for calling many recent market moves, including the rally that we have had the last few weeks. You remember back on this very show on May 20th, this man urged everybody to stay calm, remain optimistic long-term. Since that appearance, the S&P 500 is up just under 9%. Craig Johnson, chief market technician at Piper Sandler. Craig, great to have you back on. You've made some great calls. This rally was one of them. Now we're staring down the face of a 500-point down day. One day does not a trend make, I know, but are you seeing any cracks or fragility in this recent run that we have had?
All right. Thanks, Brian. Thanks for having me back on the show, and thanks for the recognizing the hard work that we've been doing here at Piper Sandler. Now, the question that I think about, putting this in the context of our trading desk, right? Like, what have you done for me lately? So we've made the call off the bottom. Where do we go from here? And I want to remind people on a couple things. Typically, coming off of major lows like we saw there in March, we typically get at least 4-5% pullbacks before the ultimate exhaustion of the uptrend plays out. And I think this is perhaps one of these little short-term pullbacks that we're going to get in the market. And Brian, I think we need to be buying that dip. Now, also, I brought in one chart, and this is one of the things that I was looking at when we were making that call for the lows back in March. And that is a chart looking at the S&P 500. We like to look at things on a weekly basis. So we basically made a 40-week moving average, made that the zero line, plotted the market around it. And Brian, the one thing that we saw that gave us the confidence to step up to buy the market was the fact that we were trading about 25% below a 40-week moving average on the S&P 500. Brian, that is something that has only happened 5 times since 1970. And when you look at that chart, it's a V bottom. And not a W, not anything else, not an L. It's a V bottom. And that's where you want to step up, take your shot, and buy stocks. And that's just one part of our
that's only happened.
Process, but I wanted to share
let's
that.
be. No, it's great, and we're gonna go back and forth on numbers here. So that's only happened 5 times since 1970. But Craig, how about this? We've only had 4 times where we've had a global pandemic in the last 100 years: 1918, 1957, 1968, and of course now. So can you look at charts the same way, given that, we're starting to see concerns about, watch out Arizona, watch out Texas. Some of the virus data is ticking up slowly.
Absolutely. You get fear, you get greed. Those emotions don't change. And that's what makes charts so important, so that you can frame up the perspective of how either oversold, overbought you ultimately are. But Brian, the one thing that I want to say about this chart and why I think people are going to buy the dip is you go back and you look at that chart, and every single time you've traded between 20-25% below that 40-week moving average. On the advance up, you have moved anywhere between 15 and 20% above the 40-week moving average before the advance is over. And that would suggest that the S&P is going to trade at somewhere between 3,450 and 3,600, which is our year-end objective, before the move is ultimately over and complete.
All right, sticking by that long-term target. Now, let's get some opportunity, because to your point, you're supposed to buy low and sell high, or buy high and sell higher, Craig. So two of your picks, ironically, one from your hometown and one from mine. Let's start with yours. Best Buy. What do you like in the charts of BBY?
So what I like about the charts is we're continuing to see a nice series of higher highs and higher lows in that chart. We're moving back above the moving averages, and we're seeing a nice consistent recovery off the bottoms. So this is a kind of stock that I like to find. I want to find stocks that are poised to break out back to the new highs and continue to push ahead, and that's what I like about the Best Buy.
The other one, Trex, Exeter Drive, Winchester, Virginia, in the Shenandoah Valley. I think the only or one of two public companies in my hometown, at least where I went to high school, on
I'm
that
here.
are publicly traded. Craig, what do you like about the fake wood decking company? Oh, he paused. See, did I render you speechless, Craig, or can you hear me? What do you like about Trex?
Oh, I'm sorry. I can hear you now. Sorry about that. So
no
what
one's
I like
ever
about
said
Trex
they can't
is,
hear me before, Craig.
So what I like about Trex is I like the fact that it's a growth stock, it's a mid cap name, and you're continuing to see this as a stock that is continuing to make new highs. So from my perspective, Trex is a name that is really playing into this trend at this point in time, where we are seeing people remodeling, redoing decks, redoing those things, and Trex is clearly a key player in this name and one of the better looking mid cap growth stocks.
All right, Trex and Best Buy as well. Craig says some drops are healthy and that he is sticking by his target for the year. Craig Johnson, Piper Sandler. Craig, always a pleasure. We're going to remember this one as well. Great job as always, buddy. Take care. All right, coming up, new data on the number of COVID cases and hospitalizations. Health data is the data that matters, and we'll tell you what you need to know when we come back. Stick around.
Dad, I'm scared.
It's only human to care for those we love and also help light their way. It's why last year Chevron invested over $10 billion to bring affordable, reliable, ever cleaner energy to America.
You've got 10 to 12 teeth missing. You can't hide that.
For years, I would dream of a place where I could go and one day come out and have all my teeth. Clear Choice put together a very personalized plan. They've got a lab there. Everything gets done in the lab. And I've got the best smile I could ever ask for in one day.
It is 100% transformation.
Do you have an idea for an invention, but you don't know what to do next?
How do you get in front of companies or get a patent?
Call InventHelp. They've been helping inventors just like you for 35 years.
And thousands of people contact them every month.
With 65 offices, you can meet with an InventHelp representative near you who will keep your idea confidential and explain their invention process step by step. InventHelp has helped over 10,000 inventors get patents. And they offer 3D animations and prototyping services to help demonstrate your idea. InventHelp's exclusive databank includes over 9,000 companies who have agreed to confidentially review new ideas, like yours.
Don't wonder what to do next. Take action right now and get the help you need from InventHelp.
InventHelp. Call today for free information.
800-916-1746. That's 800-916-1746.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
When allergies attack, the excitement fades. Allegra helps you say yes with the fastest non-drowsy allergy relief. For 24-hour relief from your indoor and outdoor allergies, say yes to life's possibilities. Allegra, live your life, not your allergies.
All right, welcome back. Well, as states continue to reopen across America, the number of new cases or hospitalizations due to COVID-19 is starting to pick up in at least a dozen states. Meg Terrell joining us now with some important data points to try to pinpoint the biggest trouble areas and what may be driving this latest increase. Meg, good morning.
Good morning, Brian. It's really sort of a tale of two different parts of the country right now, whereas we in the Northeast are starting to come down after a major peak. Some states across the country are starting to see their cases rise a few weeks after reopening. Specifically, epidemiologists are pointing us toward Texas, Florida, and Arizona as potential concerning hotspots. Let's take a look at Texas. You can see that cases have been rising. We're also taking a look at the test positivity rate. That's the red line here, to see if cases they're rising can be just explained by increased testing. And here they are starting to creep up over 5%, and they're increasing. Experts also tell us that the hospitalizations data that we've been seeing from that state mean that cases really are rising there after that reopened starting April 30th and having continued for a few weeks. Now let's look over at Florida. People say that some of this increase could be due to increased testing and also an effort to do contact tracing, but you are also starting to see those cases rise. Their stay-at-home order expired May 4th. And in Florida, the Tampa, St. Petersburg, Clearwater area is the second fastest area in the country where cases are doubling, with a doubling time of 21 days. Now let's look at Arizona, and this is a real problem area right now. Their stay-at-home order expired May 15th. They are seeing a test positive rate of about 13% and increasing. So a lot of people testing positive even as they are increasing testing. Arizona accounted for 8% of the U.S.'s new cases on Wednesday, and the Phoenix, Mesa, Scottsdale area showed the fastest growth in the entire country in the past week, with a doubling time of just 16 days, according to Evercore ISI. Now, as we're looking down at the county level for potential hotspots, some epidemiologists are using some interesting data that aren't case data necessarily, but symptom data, doctor's visits data, and even Facebook survey data about what people are feeling. So here you can see on the county level, this is from Carnegie Mellon, where the potential hotspots are. The darker, the more people are reporting symptoms on Facebook, going to the doctor for COVID, or Googling COVID. So you can see there's some dark spots in southern Florida, in the western part of Arizona, and some parts of Texas. So we are watching those closely, Brian, but a lot of folks concerned about this for these states.
Yeah, there is, and there's a few things here, and I'm sort of obsessively tracking myself. There's some Wisconsin, Iowa that are open or reopened. They're not having the spike. If we go back to that map, I think what's interesting is that's also, Meg, pretty much a heat map. Areas where it's hot. We talked about this for months, this sort of weather indicator. A buddy of mine's at Hopkins, he's talked about this with me privately, which is the enemy here might be air conditioning. Is it not? When we've learned about transmission and the droplets and the microbes in the air, open your window can become the new wash your hands, right? These are literally hot spots where people may be retreating back indoors with closed ventilation systems. Anything to that line of thinking?
Yes, this is something that I talked with epidemiologists about yesterday. The idea that in some of these states, Arizona, Texas, Florida, the southern states, it's indoor season because it's so hot. It's more than 100 degrees in Arizona this week. So the idea of air circulation is a concerning one. And also just the fact that people are packed indoors. Here in the Northeast, we're going outside, which epidemiologists and public health experts say is a safer thing to do. But in other areas of the country, Vegas too, being inside is what you're doing right now.
It is. Yeah, I mean, listen, keep the window open, I guess. Keep the breeze going, even if it's hot. I think Meg Terrell, very important story. Health data is really the economic data we care about right now. Meg, thank you very much. All right. Well, speaking of economic data, the Federal Reserve projects the U.S. economy will shrink by 6.5% this year, unemployment dropping to just above 9%. Central bank signaling it expects to keep a major level of support for the economy in place for the year, including rock bottom, basically zero interest rates through 2022, with rates so low. Your next guest says the housing market could be the driver to lead the country out of recession. Jeff Taylor is co-founder and managing partner at Digital Risk. That is the nation's largest provider of mortgage risk compliance and transaction management technology. Jeff, good morning. The housing market in many areas has been red hot, particularly in the Northeast. Any sign of a slowdown?
Good morning, Ryan. Thank you for having me. What a different housing market that we have right now than we did 10 years ago. If we look at the overall numbers, we have $33 trillion is the size of the U.S. housing market. That's up over $10 trillion from 2012. We have home equity at $18 trillion right now. That's up from $6 trillion in 2010. The housing market heading into this pandemic was, like you said, at all-time as highs from equities, strength of the consumer. So it's been fantastic. And working with our servicers and our lenders, it was an unbelievably strong market. Yet now, post-COVID, we're dealing with this other pandemic, other issue, which we're also looking at the fact that we have all these mortgages now that have gone to forbearance, about 4 million of them. Good news here, Brian, that not many people know. About 32% of those borrowers who have jumped into forbearance are actually still paying their mortgage. And that's critical compared to what we saw in the financial crisis. That means that over the last decade, they have really built up that home, that equity in their house, and they value it. And they're not just at the first sign of an opportunity not paying their mortgages. They're continuing trying to stay into it, paying the mortgages. So when they come out of it, they may need to tap that equity to make it to bridge this pandemic or the next year in their life, and they really value their houses. So overall, I think the housing market's never been stronger, never been structurally different. Yeah. And also by use of technology, we have much better ways to help consumers and lenders reach out to different borrowers.
You know, and that's important, Jeff, because obviously financials took it on the chin yesterday, and sort of you could make the argument that maybe the most important macro stock in America right now might be Wells Fargo. Wells Fargo down 44% year to date. It is down big again this morning. They are, I believe, the top two mortgage holder and originator in the United States. So your data goes directly to companies like that. Are you seeing signs? You just gave us a little good news. Are you seeing any signs that the mortgage payment situation may get worse or better in the coming months and quarters?
Yeah, like I said, right now, I think it's going to get better. I mean, look, if you have 30 of the 4 million people that took out these forbearances, 32% are still paying. So what does that tell us? It tells us that they took it out as more of an insurance policy right now. They want to see, they might have some issues, they may be looking at some coming forward, but they took it out as an insurance policy and they're still paying. So I actually think that we've leveled off at forbearance. You know, Director Calabria said it's about 6.7% for the mortgages that Fannie and Freddie own right now. I think we've hit that peak. I think that we start to come down. And the good news about that is the big banks, you just called out Wells Fargo, they've got great systems and people and process in place to go ahead and help the borrowers to make sure that if they do need assistance, whether it be modification, different repayment plans, that structure is in place to do so. So again, I look for a very, very strong housing market coming forward. And actually home price depreciation, I think it's flat this year. And believe it or not, I think maybe we're up 1% next year. So I think it's very strong.
It is very important data. It's the biggest purchase that we all make. Jeff Taylor, co-founder of Digital Risk. Jeff, pleasure to get you on in housing. Thank you very much. Take care. All right, coming up, futures. They are down sharply this morning. Dow futures down 508 points. And coming up, we get advice from veteran market strategist Jeff Kleintop. The markets have rallied back. Some stocks at new highs. What do you do now? We'll talk to Jeff about just that next.
Derek, seems like your team's operating just fine remotely.
Yeah, everything is running smoothly with the Now platform. See? Incident resolved.
How did you?
Gotta enjoy the small wins.
You keep being you, Derek. Keep being you.
ServiceNow, the smarter way to workflow.
Need better sleep? Try Nature's Bounty Sleep 3, a unique tri-layer supplement that calms you, helps you fall asleep faster, and stay asleep longer. Great sleep comes naturally with Sleep 3, only from Nature's Bounty.
We're Weaver, a national CPA and advisory firm. And we firmly believe that when you put people first, the numbers follow. Weaver, accounting for more than numbers.
Our company's talent playbook just went out the window.
We need a partner to help us stay ahead.
Who can help us change the way we work?
That's what Kelly does. Companies of all sizes are having these conversations. Kelly can connect yours with the right talent solutions. Visit that'swhatkelly.com.
Okay, give it a try.
Between wisdom and curiosity, there's a bridge. Between ideas and inspiration, trauma and treatment.
We need a couple of more pounds.
That's good for the baby. Between the moments that make us who we are and keeping them safe, private, and secure, there's WebEx.
Beautiful.
Imagine feeling fearless at the dentist. Imagine strengthening enamel while preventing cavities 70%. Act anti-cavity. Stop imagining. Start acting. And now get anti-cavity protection in new dye-free iced formulas.
All right, welcome back. Well, time now for our weekly insider buying list, the 5 companies with the most execs buying their own stock. Normally we do this on Fridays, but I'm off tomorrow, so we'll do it today. The data coming from insiderscore.com. Let's jump right into it and get to Jeff Kleintop. All right, the stock with the 5th most insider buying this week is Allegiant Airlines. The president buying 5,000 shares, but do note the CEO did sell some stock the day before that. Keep that in mind. Stock 4. Fossil, multiple insider buys there at the beaten up retailer. Stock's down 53% in the past year. By the way, it's stock under 500 million in market cap, but we'll talk about it because it was a big name. They got a lot of shares outstanding. All right, stock number 3 is Extreme Networks. We are seeing insider buying there. Multiple insiders buying 844,000 shares in the past week. A new name at number 2, Residio Technologies. The chairman and CEO buying 1.5 Residio Technologies. We're seeing insiders buying there, the stock. Anyway, and the stock with the most insider buying this week, he said, is Cortexime, a venture capitalist, an early investor, buying over $2 million worth of CRTX. Allegiant, Fossil, Extreme, Residio, Cortexime. There's your top 5 insider buy companies this week. We do it every week from insiderscore.com, and here's why. The average gain of the 25 or 30 or so stocks that we've highlighted since we started doing this segment is a gain of 48% this quarter. That is 25% more than the S&P 500 has gained. The insiders, they have timed it well. Pay attention to that data. All right, we'll pay attention to this as well. Stock futures, they are down sharply, exactly 500 points right now. The nation continues to try to reopen to stave off a further economic downturn. And your next guest says some data points and key indicators are pointing to signs of a continued recovery. Let's bring in Jeff Kleintop, Chief Global Investment Strategist at Charles Schwab. Jeff, important day to have you on. Not going to make too much of one day, obviously. As our previous guest, Craig Johnson, said, you can't go up every day. You need healthy pullbacks. But is there anything in any of the virus data or reopen data that has concerned you and your team in the last couple of days?
There are a few data points that are a little worrisome. Germany's manufacturing sector has slowed down a little bit. We have seen a second wave of a virus actually break out in Sweden and Iran. The second wave is real. It is taking place. Fortunately, we have not seen a rise in mortality along with that. I don't know if that's because high-risk populations are taking greater precaution than in the first wave, but we're not seeing the same type of hit to humanity. And that may be a really good sign in that it may mean that people remain engaged in the economy. We don't need to see a second shutdown in response to that second wave.
We had a guest on, Jeff, from was an equity analyst earlier this show. He said that, Carnival Cruise Lines, they're starting to push back their planned resailings. If we start to see companies say, well, we're going to open here, if we start to see the signs of, I don't want to say reclosing or re-shutdown, but delays, because data pops up. What does that mean for the equity market?
It's certainly a setback. So the recovery is taking place based on all kinds of measures of data that we're looking at. Recognize this. So the market is vulnerable if the pace slows or we see setbacks, as you point out. Yet the may not mean we're trading all the way back to March lows. Since it's only been in recent weeks that we've seen cyclicals lead the market and bond yields start to move. So it's only been more recently that investors have embraced a more optimistic outlook for a more rapid economic recovery. So a pullback on some of this setback, if indeed this is the case and we get a number of setbacks in the data, we may only give back maybe the last few weeks of the move in the market rather than a return to the lows. But I'd add that I think the bigger risk for investors might be that they're expecting a further rebound in the wrong stocks. They're looking to see leadership from the old leaders of the last cycle rather than new leadership that always comes with a new cycle.
It's like the pandemic, as far as investing goes anyway, Jeff. It's like people just went back to what they were doing pre-pandemic. Oh, let's buy Apple, let's buy Microsoft. They're valued at now $1.5 trillion. That's fine. You can buy high and sell higher. Any unloved sectors, globally, emerging markets, small caps, that you and your team think maybe haven't reflected some of the optimism down the road?
Yeah, I'm increasingly excited about the financial sector. This is an area that's been left for dead for the last 12 years. And we're actually, maybe with a little yield curve steepness, maybe with maybe we're not seeing as much in terms of loan losses as maybe these companies have reserved for. Maybe they're able to turn those dividends back on again. This is an area that in recent weeks has led the market, along with cyclicals, along with value stocks, that I think will actually be the leaders of this next cycle, as we often see this rotation between growth and value every other cycle. And I think we're poised for that. So that's an area that could really look quite good going forward. Again, an area that's been unloved.
Well, very unloved, by the way. And Wells Fargo down again today. We'll have to watch it, but we need your insight. Jeff Kleintop of Schwab. Jeff, great stuff. Thank you very much. Folks, that does it for Worldwide Exchange. Dow futures, they've come a bit off their lows. Still down 482. Could be a big day for the markets. I'm off tomorrow. I'll see you on Monday. Squawk and the gang pick up a big day of coverage next. Be well. Take care. See you soon.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
What is your lotion wish?
I want coconut oil, cocoa butter, shea butter, and no more reapplying.
We listened. Gold Bond Radiance Renewal gently exfoliates, then our triple blend of moisturizers helps prevent dry skin. Gold Bond. Ultimate lotion, ultimate skin.
For a close shave, you need to get a razor and lather up. For a quick shave on the go, you need to settle for an electric. But what if you really want both? Nick Bolton here with the newest addition to our tactical line, the Bell & Howell Tax Shaver. Tax Shaver gives you a quick, razor-smooth shave, whether you're at home or on the go. It even has a built-in trimmer for sideburns and beards. And it works wet or dry for a great shave in even the harshest conditions. That's right, the Tax Shaver is completely waterproof.
Act now to get your Tax Shaver for the special TV price of just $29.99 with free shipping. It's the only shaver that features genuine Bell & Howell precision and quality and is backed by our 10-year warranty. Here's how to order.
To order, call 1-800-953-7061 or go to taxshaver.com. That's 1-800-953-7061, or you can order online at taxshaver.com.
On Squawk Box, reopening the economy. Real-time numbers on where the action is. Retailers ready for business. Consumers ready to spend. Today, 6 a.m. Eastern. Watch or listen live on the CNBC app. Analysis that gives you an edge. Fast Money, 5 p.m. Eastern on CNBC.
Pete Davidson is the king of Staten Island.
Are you a weirdo?
Oh, the weirdest.
You make everyone around you crazy. People are normal, then they hang out with you, and then they're Jack Nicholson in The Shining.
I gotta tell my mom he tried to drown me.
It's an above ground pool. You're like 8 feet tall.
The King of Staten Island. Rated R. On demand Friday. Go to thekingofstatenisland.com.
Breaking news, stock futures are indicated quite a bit lower this morning. That'd be the third straight day in this pullback, but it seems to be accelerating. We're down almost 500 points hours after the Fed issued a gloomy outlook for jobs and the economy. Travel and leisure stocks among the hardest hit. Will show you the big drops in airlines, hotels, cruise lines, and gaming. Plus, what will sports look like in the fall? CNBC has an exclusive look at the changes being made to stadiums to get ready for the reopening, which there's a little bit happening today in the golf world on the Golf Channel. It's Thursday, June 11th, 2020. Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Let's take a look at those U.S. equity futures. As Joe mentioned, they are under quite a bit of pressure this morning. Looks like right now the Dow futures are indicated down by about 480 points. Again, this would come after a couple of days of declines already. Yesterday, the Dow lost 282 points, and then the day before that, it was down by 300 points. So if you add that to the almost 500 points down today, you get more than a 1,000-point decline just over these last three sessions. Of course, it's early going right now. We'll see what the market does as we get closer to the opening and then, of course, the closing bell today, too. But right now, some rough futures. S&P futures are down by 43. The NASDAQ is down by 101. And a lot of this is coming because of the Fed's gloomy outlook that's been weighing on those stocks. The central bank indicated that it would keep interest rates near zero as the economy recovers from this pandemic, but they projected that the U.S. economy will shrink by 6.5% in 2020. They do see a gain that they're expecting at least of 5% in 2021, followed by a 3.5% gain in 2022. The Fed also said that it will continue increasing its bond holdings, targeting Treasury purchases at $80 billion a month and mortgage-backed securities at $40 billion a month. If you take a look at the 10-year note at this point, the yield came back under some pressure again yesterday. It's now sitting at 0.698%. And then crude oil prices have also come down a little bit, too. If you've been watching that, you'll see that WTI is down by about 3% this morning, last ticking at $38.38. But, guys, a lot of this is because of what the Fed is now saying. Yeah, it's going to be hanging in there and keeping interest rates near zero, but that's because they are really expecting some tough economic sledding.
Right. The news out of some 12, 13 states probably not great for sentiment either. And it's probably not great that the high S&P target on the street, we got there in like a ridiculously short amount of time. So what do you do at 3,200? I was actually thinking about how I think it'd be hard for me to sell right now. I mean, you wait around. We don't invest. We don't do that.
You would have wished you'd done it 3 days ago.
Well, no. Now that's the hard thing. I'm not sure buying is the hard. So that makes me think. I don't know. You get all the way back to 3,200, which you would have killed for 2 months ago if you were long. Yeah. And now we're here, and I mean, it's not gone. It's we've got people out and about, whichever example of people going out you want to talk about. Some people talk about the demonstrations. Others just talk about beaches and just opening up. For whatever reason, there is a chance for transmission now, isn't there? I mean, it just seems like... And is it a second wave or is this the first wave? Like in Arizona, they didn't go through the first wave, places. Did they?
Right. Did you hear Meg Terrell, who was on with Brian Sullivan just a little bit ago? She was talking, too, about how in places like Arizona and in Texas, it's really hot, more than 100 degrees. So a lot of people there are actually inside again, which is where, when you're inside, it's more transmissible, too. If you're out in places that are inside because you're recirculating the air, and at least if you're outside, that is pertained to be a little healthier, less likely to transmit things. But if you're in close quarters and you have a lot of people there, not necessarily in your house, but if you're in a mall or an inside dining area or something, then it's a little more concerning if you don't have the outside air.
Right. And we've been talking about 4 years at zero, right? And what the Fed says it. So now they didn't even say 4 years at zero. They just said for an extended period. But
well, that's what I mean. If they had said they weren't going to keep it at zero, I think the market would have panicked too. It's the economic outlook that I think people were watching to say, oh yeah, there's a reason they're keeping it at zero. Andrew, I'm sorry.
Well, the only thing I was going to add to this is, we saw the Starbucks numbers yesterday, and then we saw what the Fed had to do. But part of this, as I was on the phone yesterday with a number of hedge fund managers, I think there's just a lot of profit taking that's happening right now as well. So it's hard to, I think, to fully extrapolate out. Yes, there's some bad news in the market right now, but I also think there's some folks, there's a view, by the way, among a lot of professionals that some of this market was run up by retail. We had that conversation with Brian Sullivan yesterday, and whether you think the professionals were sort of playing along and now are starting to get out. I think there's something in that vein that's happening. Hard to try to understand exactly what it is. That's a great point too, Andrew.
I mean, if you're one of these hedge funds and you were looking at being down 40% or something, and then you can say, forget it, I can take that off the table. It would be a great time to profit.
You should get your person. Becky always gives you all these stats, Shaq. Now to go back and just add up the total Dow point gains last week, the week before, and the week before that, just each week.
I was trying to do that myself because if you look just at the last, if you added the futures this morning to the last 2 days, it's almost 1,100 points.
Right.
But we were talking about it's 6 days over the Dow. And Peter's listening to the show all the time. Peter, if you can maybe run the numbers on that over the 6 days that we saw, where the Dow just skyrocketed. I was trying to figure out 1,100 would be giving back how much of the run up that we'd seen over the 6 days.
Because we just do talk about we're up another 450, 500. We talk about that like that, but when it's down, it's like, oh my God, we're plummeting down. So it's just the nature of I guess the news business.
Volatility is here though. Remember, there used to be days before any of this happened where we'd be like, oh, the futures are up 7 this morning. Not talking about the S&P futures, the Dow.
Yep.
Right. I'm not going to go into my tired. This is, when I was growing up and walking to school uphill both ways, but I always bring this up. You're sick of my old stories, but Joe Granville crashed the market, and it was 27 points. He crashed the market with the most bearish comments, and the Dow dropped 27 points, and we didn't know if we'd ever, come back from that. Anyway, let's take you through some of the areas. Then he started dressing up in a pharaoh outfit with a big staff and talking about earthquake predictions. So, I don't know, Joe kind of jumped. But he was the greatest technical analyst probably ever and wrote the treatise on a lot. Anyway, take you through some of the areas getting hard hit this morning. Trail stocks are under pressure. There are the airlines. Those are big moves there. We've noticed that in the overall averages, 8%. Cruise stocks, which had been hard to understand the big rally there. Some of the speculative froth maybe that we were talking about as those came back, now down over 8%. Hotel stocks. See this? Does this look like it's Fed or does it look like it's second wave worries? I don't know. There's Marriott, Hyatt,
Looks like it's Andrew could be right. Profit taking. Those stocks ran up so much.
They've moved that. Well,
I don't know.
When bankrupt stocks start going from 1 to 7, then you really start. It's like, wow, it's so cheap at 1. It's like, yeah, it's probably 0, and that's the attitude of some people. And then you tell them they're stupid, but they sell out at 5. It goes from 1 to 5, and they're like, why am I stupid? Did you just quadruple your money? No, I didn't. Anyway, take a look at some of the biggest drags on the Dow this morning. Boeing accounting for about 80 points of this sell-off. Boeing, which also has run up an awful lot. We talked about that last week. It was up like 55% in a week. But it also would be affected if we're not totally out of the woods on the virus. Andrew.
Okay, we got some corporate stories to tell you about as well. This one surprising the market. Shares of Grubhub jumping after the company announced it plans to merge with European food delivery company JustEatTakeaway.com. Now, earlier in the day, David Faber had reported that Grubhub and Uber had agreed on a merger price, but that deal had fallen apart because the companies were concerned about antitrust pressure and couldn't agree on how Uber would support Grubhub through the regulatory process. Now, Uber's offer had valued Grubhub at about $70 per share, while Just Eat Takeaways offer values it at $75.15 per share, although the European stock fell on that news, lowering the total offer value now to about $65.17 per Grubhub share. But it's an interesting transaction. So I don't want to say it came out of nowhere, but I think there really had been obviously an expectation that Uber or one of the U.S. players would come in and do this, and that's where the consolidation would happen. And clearly that's not happening. Interesting that antitrust was on people's mind. There was a view also that maybe amid the pandemic and the need for these type of essential services, that maybe antitrust would look the other way, if you will, about some of those types of issues. So unique moment in time, but maybe this is also a sign that Elizabeth Warren and others, remember, who had tried to put forth a bill that they put forth a bill that it didn't get approved, but the bill was to effectively end or postpone all transactions during the pandemic because of antitrust issues as being one element of it. So it's a pretty interesting one for those in the deal world this morning. Yeah, Becky?
Andrew, the other thing on that, remember when we had Derek Khosrowshahi on talking about some of those issues, just how Uber Eats, even with all of this, even with the pandemic and people using it so much more, is still not profitable. So, you kind of look at those issues, and anybody who looks at it and figures how you make money on this is there's going to have to be consolidation. You can't have these players kind of coming at each other and all cutting to try and get the customer to come into the whole situation. So until there's consolidation, a lot of people have thought it's just not going to be profitable.
Right. So the question now, of course, is what happens to the DoorDashes of the world? There are a number of other players out there. Does Uber try to pick one of them off? Clearly, I think based on the comments that Derek Khosrowshahi had made to us and also their own interest in Grubhub, you'd imagine there will be more, that Uber thinks it needs to do something, in part because of exactly what you just said, Becky, which is this is still a money-losing enterprise. And part of the reason maybe is there's too much competition, which then raises the competition issue. So a little bit of a conundrum there. We've got a lot more coming up on Squawk Box ahead. A CNBC exclusive look at the changes being made to stadiums as America looks to bring back live sports. We'll talk about that next. Take a look at U.S. equity futures right now. As we've been mentioning all morning, the Dow off over 500 points, about 522 points right now. S&P 500 looking to open down about 50 points. NASDAQ off about 113 points after some, I don't know if we'll call them bearish comments, but sober comments by the Federal Reserve. We'll be right back after this.
Can I find an investment firm with a truly long-term view that's been through multiple market cycles for over 85 years? With Capital Group, I can. Talk to your financial professional or consultant for investment risks and information.
Helps you say yes with the fastest non-drowsy allergy relief. For 24-hour relief from your indoor and outdoor allergies, say yes to life's possibilities. Allegra. Live your life, not your allergies.
There's not enough Black representation in research and development in pharma and biotech companies. I need to invest in the education. Like 23andMe ourselves, we need to have intern programs. What are ways that we can support that kind of growth?
We want to be, by the year 2025, 30% of our executive talent that would be at the vice president above going through the boardroom would be minority talent.
This time should be different. This time has to be different. Let this not just be another stop by another grave marker.
Hi, Linda. Looks like you've got a prescription to fill. Any idea how much that's going to cost in there? The exact same drug that's $10 at this pharmacy is $150 at this one. GoodRx finds prices and discount coupons on every prescription. Just input the drug name and instantly find savings at virtually every pharmacy in America.
Next. What can I do for you? Here's my prescription, and I have a coupon from GoodRx. Nice price.
Stop paying too much for your prescriptions with GoodRx. These folks, they don't have time to go to the post office. They have businesses to grow, customers to care for, lives to get home to. They use Stamps.com. Print discounted postage for any letter, any package, anytime, right from your computer. All the amazing services of the post office, only cheaper. Get our special TV offer, a 4-week trial plus postage and a digital scale. Go to Stamps.com/try and never go to the post office again.
Welcome back to Squawk Box this morning. As sports return, stadiums will look a lot different post-COVID. Diana Olick got an exclusive look at what fans can expect.
Barely 6 months ago, Miami's Hard Rock Stadium was rolling out the green carpet for a Super Bowl crowd of 65,000. Now the Dolphins and the rest of the sports world are trying to figure out what their stadiums will look like in the age of COVID. Dolphins president Tom Garfinkel said in early May that they were already considering how to drop capacity to just 15,000 fans, and he is not alone.
Every venue in the country is having these conversations right now. We're talking to baseball owners, football owners, basketball owners, and their operations staff literally every day.
Don Barnum leads the global sports studio at architecture firm DLR Group.
I think we're going to see changes in the entry sequence, food and beverage service, and the most impactful thing will be in the seating bowl itself.
Barnum and his team are creating virtual designs showing how seating could be modified to create socially distanced boxes complying with the CDC's 6-foot separation, which would result in only about 18% stadium capacity. Then, more socially relaxed standards as requirements change.
What we hope is that is either the threshold to start from, and then we move through maybe different gradations of 20, 30, 40, 50%.
They also looked at expanding more social viewing areas.
So you might stand at a railing and watch the game, or be in a bar environment where in between socializing, you watch part of the game.
Food services will also change, with fans ordering and purchasing on apps from their seats and then getting an alert when quick pickup is ready. Ticket entry will also become contact-free.
We put a ticket scanning system into a 75,000-seat stadium last summer, and that was a cost of about $1.5 million.
Now, costs will, of course, vary as you run the gamut of facilities from major professional sports stadiums and arenas to colleges, large and small, and even high schools. But no question, there will be sizable investments across every sports franchise and venue. Back to you guys.
Okay, Diana, thank you for that report. As the post-COVID world really is being reimagined, some states, as Joe mentioned earlier, are seeing some spikes in the cases. And for more on that and a whole bunch of other questions, Dr. Scott Gottlieb joins us as he always does every morning. Former FDA commissioner, is also a CNBC contributor, serves on the boards of Illumina and Pfizer. And let me just put it to you, how concerned should we be? I know we've been asking this question for the past couple of days. We've seen some additional spikes, but put it in context for us.
Well, look, I think we should be concerned. But when you look at states like Arizona and Texas, South Carolina, North Carolina, those are where the big outbreaks are right now. Florida, to some degree, seems to be going up. It's not a second wave. They never really got rid of the first wave. If you look at Texas and Arizona, for example, they really weren't that hard hit relative to other states during February, March. And so they just had some infection. They had persistent infection. Now we're starting to see it go back up as they reopen. I think the concerning part, well, the cases are certainly concerning, but I think the more concerning part is they haven't been able to isolate what the source of the infection is. In some states where you're seeing infection rates go up, it's related to a facility or a particular prison or a nursing home. In states like Texas and Arizona, it seems to be more pervasive, and they haven't been able to do the contact tracing to find a source or a group of activities that they're able to take action on. And that's what's concerning right now. So they haven't really been able to take effective public health action yet.
Doctor, can you explain this? And I think there's a lot of folks in the health community trying to figure it out. You look at a place like Arizona that's clearly now having spread, but then you look at a place like Georgia, which was really the first to reopen, not having spread. And you look at a place like LA, which was one of the first places to close down, and now all of a sudden there's more spread happening there. How do you explain those differences?
Well, look, how do you explain the fact that New York had a horrible epidemic and other states, other cities didn't have the same level of spread? You know, the infection gets into certain environments, gets transmitted through certain social routes inside cities, and once it takes hold, it becomes hard to extinguish. It becomes heavily seeded, and then it becomes hard to extinguish. Georgia isn't out of the woods. They do have spread. It's been persistent. It just hasn't been flaring up. But this is a kind of virus that could flare at any time if it gets into the right environment, the right setting, and starts to propagate. Right now, you look at states, I know you mentioned this, you look at states like Georgia and Arizona right now. Phoenix, it's 110 degrees. Houston, it's about 95 degrees. And so whatever seasonal effect benefit they were going to get, they're probably tipping over right now, and more people are being driven indoors because of the heat than being able to do activities outside as well. And that might explain some of the spread as well in those states, the very hot states.
I gather there's some concern about the supplies of remdesivir, and I wanted you to speak to that. The government's supply of remdesivir in terms of access to it, in terms of number of people who may need it, and when we run out of at least the initial supply that's been created.
Well, it's going to depend on how many cases we have this summer. The supply that we had should last us through the next couple of months, assuming that the hospitalization rates don't go up substantially from here. It's a drug that's likely to be reserved for hospitalized patients and those who present with signs and symptoms, comorbidities that predict that they're more likely to have a worse outcome from coronavirus. And so it's going to be given to the patients who come in who present that are more sick. I think heading into the fall, we are going to have substantially more supply so that if we have another epidemic on the scale of what we had during the first go-around, there should be enough for most of the more severely hospitalized patients. But it's touch and go to some degree. Gilead's brought on a lot of new manufacturers, and they've managed to substantially compress that manufacturing process. So we should have supply for the hospitalized patients. The same thing goes for the therapeutic antibodies. We're going to be dose limited on those as well. I think those will come onto the market sometime in the fall from Lilly and Regeneron. But both companies are likely only going to be able to supply about 100,000 doses a month for treatment. They'll be able to have more available for prevention because you need less for prevention, but most of it's going to likely go for treatment, and they'll only have about 100,000 doses apiece for treatment. That should be enough potentially for severely hospitalized patients, but it's not going to be enough to provide it to everyone who presents with coronavirus. We're going to be able to bring down the death rate if we do have a second wave. We've learned how to treat people with this disease much more effectively. So we're going to see the mortality rate come down, but unfortunately, it's not going to affect how many people ultimately get sick and hospitalized with it.
Doctor, I got an email last night from a CEO who asked me to ask you a question, which was they are looking at various testing, different types of tests that they can give their employees, including the Abbott test, which is a very fast test, as you know, some of the PCR tests and some of the others that take a little bit longer, in some cases hours, in some cases days. What are you recommending if you're running a company with in this case,